I want to start this course with something simple and honest. For a long time, I traded my time for money. I went through Goldman Sachs, I did the whole 9 to 5 thing, and that was kind of the dream on paper, right? But honestly, it was still like a treadmill. I had to come to work at 6 o'clock in the morning because I was on the West Coast, and although I was getting paid good money, I didn't really have any freedom. So you stop working and the money stops. And somewhere along the way, over the last 11 years, through educating myself, through doing trial and error, through painful mistakes, through reading tons of books, studying other investors, having mentors, I have deliberately learned option trading. I have changed my relationship with money, finally, after learning what I'm going to teach you in this video. And the thing that changed for me wasn't some magic trade. It was understanding a tool deeply enough, such as technical analysis. It was understanding which stocks to buy. It was understanding how to open, manage, and close trades, which I'm going to show you with live examples in this video. And a combination of understanding how to use the stock market to my advantage by being invested in the right stocks, using the right strategies, knowing when to get in, managing trades, and getting out of trades, even if not done perfectly, has allowed me to gain financial freedom, has allowed me to gain time freedom. And honestly, this means a lot to me because I get to teach you the same skills that took me 11 years. I get to now teach this to you in this retirement course. So in the timestamps below, you can see a full map of what I'm going to be teaching you. And if you want to skip around this video, you're welcome to do so. I'm going to be teaching you different strategies. I'm going to be using different tactics on those strategies. For managing those strategies, I'm going to discuss both call options, put options, passive income strategies such as selling options. I'm also going to discuss more aggressive strategies such as leaps in generating income on leaps. This is one of the better retirement strategies that I have used when I was scaling my portfolio back in 2021. When I scaled my portfolio from $100,000 to $700,000, I used a lot of leap options and I picked growth stocks. So I'm also going to be using the strategy that personally works for me. And I'm also going to show you a strategy that you need to learn along the way and when you finally get to your end destination, which is retirement. So we're going to be going over all of that. And as we learn about the different option strategies that I use, I'm also going to be showing you how to actually pick a trade, how to use fundamental analysis, how to use technical analysis, how to analyze a business. And we're going to be looking through the entire journey of picking a stock, picking an option strategy, and then successfully getting out of a trade step by step. Now, before we go any further, I need you to know I'm not a financial advisor. I'm going to be using all these examples. I'm going to be using my personal money, but you should use this as educational purposes only. Now, why do I choose options over just buying stocks? So that's a fair question, right? Because a lot of stocks right now will have a lot of volatility and there's a lot of opportunity in the stock market. There's a lot of AI stocks that, for example, Micron is up this much year to date. Nebius is a top pick in, some of the biggest hedge funds in the world. And these stocks are up a lot. So why would I be using options to begin with? Because isn't just buy and hold a perfectly good strategy? Well, it is. But using options can greatly either reduce your risk. They can also greatly increase the overall return that you can get. And I personally like using options because they're just so much more versatile. For example, if you buy a call option, you have a leveraged bet on your hands. And if the stock goes up 10%, a call option can go up 30, 40, 50%. And that's because a call option is more risky. It is a leveraged bet. So whenever you buy a call option, you're betting on a stock going up, except a call option uses a lot less capital up front and gives you a big leverage effect. You have a huge gain that you can make if you have the right view on a stock by using a call option. So let's not waste any time. Let's open up my portfolio and see what I've done to grow my portfolio to multi-seven figures and what you can learn about it. Even if you have a portfolio today that's $30,000, we all have to start somewhere. I started with $2,000, and throughout my journey, it took me many, many years to scale that $2,000 to 7 to 20, and then from 20 to 100, and then finally, I had figured out, what works, what strategies work, and I had taken account from 100K to 700K with a leap strategy, which we'll discuss later on in this video. Now, first of all, I wanted to go over a call option. What is a call option and how do you use it? A call option is simply a bet on a stock going up. Each call option represents 100 shares. So if I go to a call option right now, let's use NVIDIA stock, right? NVIDIA is not a cheap stock. So let's use NVIDIA, NVDA, and I want to show you what a call option looks like. So NVIDIA is currently trading for $200 per share. Now, I can buy the stock, right? I can spend the money up front for the stock, and that's going to cost me $20,000. Yeah, 100 shares is $20,000. So instead of having to buy NVIDIA for 20 grand, because not everyone has that money laying around, and even if you do have that money laying around, it might not be the most efficient use of your capital. So instead, go to trade options, right? And I'm going to go buy call option. Now, you can buy a short call expiration or a longer call expiration. A short expiration could be something like, I'm making this in late June. If you're watching this in the future, totally okay, because you can apply all the principles for your own portfolio. You can just use my logic, my thought process, and the methods that I'm using in this course are much more important than the timing. So if you're watching this in the future, no problem. Look, if I go for a shorter expiration, like, I don't know, July 2nd, right? And it's late June, so this is just like less than a week. Well, then the options are going to be pretty cheap. Okay, so if I go for a 200 call option right here, a call option gives me the ability to make money if NVIDIA goes up, right? This call option is worth $400. So the break even is 204. Okay, I'm getting break even, by the way, because I'm taking the call option strike price. A strike price is basically the price that you're betting that the stock will go above. Okay, that's going to be 200. And actually, NVIDIA is already at 201. So this is called an in the money option. Okay, an out of the money option would be a 205. So if I go 205 right now, this is an out of the money option. You're hoping that NVIDIA goes to 205 or higher. Okay, so let's start off with this out of the money option. Out of the money options are easier to understand than in the money options. And we'll do lots of in the money work when we go over leap options. Okay, so let's start off with something more simple and more beginner friendly, which is a 205 call option here on NVIDIA. If NVIDIA goes to, $205, you start making money because this would now be an in the money option. Currently, NVIDIA is at 201, so this is an out of the money option. Okay, so if I click into this option right here, this is basically an option chain. This is the option statistics. Okay, so this option expires on June 2nd. This is a 205 call option, and I'm going to go over kind of what you see here. So first of all, there's a bid and an ask. Okay, an ask is essentially what you kind of have to pay for if you want to buy this option, and a bid is essentially what you can sell for if you want to sell this option. Now, typically you can go for the middle price. Okay, that's why right here we see mark. Okay, the mark is 228, which is essentially like the middle point. Okay, so if you're going to be buying this option, you essentially just are going to be paying $228 for this option contract. Okay, so going back here into the basics, if the strike price is 205 and I'm paying $2.20, then my break-even price is going to be 207.20. Okay, so that basically means that at 207.20, everything above that is profit. However, that is at expiration. Okay, before expiration, you can also sell the option for a profit anytime that you wish. For example, I could just buy this call option right today, and then within a few hours, if I have made money, I can just go ahead and sell it. Right, you don't have to hold an option until expiration. A call option gives you the benefit when the stock goes up. The holding period is something that you choose, and we'll talk about managing this trade and how to kind of sell it when we go over, more of the live examples and when we go deeper into this. But the whole concept is a call option gives you a benefit if the stock rises. If you have a 205 call and you pay $2, your break-even price is 207. Everything above 207 is yours. You are making money, okay? If NVIDIA goes up to $300 per share, that is a pretty huge move in the stock, right? I mean, going from 200 to 300 is a whole 50% gain, right? That is a lot. This option is going to experience an insane gain if that happens, right? But the real benefit that you get is through delta, okay? Let me explain to you what delta is, okay? Delta is the most important Greek, okay? There's something called Greeks in option trading. Greeks are essentially trying to explain how an option behaves, right? So if you look at delta, this is the most important Greek of all. Delta essentially tells you how much an option moves when the stock moves. So if NVIDIA goes up $10, how much would the option move up? Well, it would move up by $10 multiplied by delta, okay? So essentially if delta is 30, then this call option would move up by $3, okay? So if the stock goes up by 10, the option will move up by 3 if the delta is 30. If the delta is 50, then the option will move up by $5, okay? If the delta were to be higher, then you get a more sensitive move, okay? The higher the delta, the more the option moves. The lower the delta, the less the option really moves when the stock moves, okay? So when you're buying an out of the money option, that's okay, because an out of the money option is fairly cheap in this example. It's $2, okay? This is a short expiration. Let's go over another example where we go over something a little bit longer. So if I go for an option that's going to be for, let's say September, which is a couple months out, these options are now more expensive. We just looked at an option that was a couple $100. Now, when you look at September expiration, these options are much more expensive. Now, why is that the case? Well, let's go back into the Greeks. Here, delta is higher, okay? That in and of itself is partially the reason why this option is more expensive. It's because the delta is higher. That means you get more benefit. If the stock goes up, this option goes up more than 30 delta because it's 50 delta. So it goes up by 50 cents versus 30 cents for each $1 or difference between $5 move and a $3 move and a $10 move in the underlying stock, okay? However, the reason why this is also worth more is because there's more time. Time is really valuable. We all know that, right? Because a lot of us trade time for money. Pretty much everyone trades time for money, unless you own a big business and, you still probably have to work, but most people trade time for money. So time is valuable, and it is super valuable in option trading because time equals more value, okay? So the longer the expiration is for an option, the more value it's going to have because more can happen in that time period. Does that make sense? So in one single day, not a whole lot is going to happen with this stock, right? Within reason. If it has an event or earnings, yeah, sure, a lot can happen. But generally speaking, more can happen in a week than can happen in one day, and more can happen in a couple of months than can happen in 1 week, right? So that's why this option is worth more. And time, or the passage of time, that is theta. So as you can see here in the Greek, theta, it is 0.1. And what that means is when you buy a call option, you're essentially renting 100 shares, right? Let's call it for what it is. You're renting 100 shares, okay? You don't own 100 shares. You're putting up a smaller amount of capital and you have the same benefit, but eventually this option expires, right? And if this option expires out of the money and NVIDIA does not go to 205, you'll lose all your money. You'll lose everything that you paid for this option. So in this example, right, 1405, you can lose all of it if NVIDIA doesn't go to 205 or higher. If NVIDIA ends at 203, you're losing 100% at expiration. Now, we'll talk about risk management later in this course, and I'll show you how if you were to sell this before it gets to that point and when you can do that, then you can practice safer risk management principles. And for example, you can cut this position for half a loss. We'll go over that later, but you never want to be in the position where you lose all your money. But still, if you do hold till expiration and this is out of the money, then you have no value of this option. There's two values to an option, by the way. There's intrinsic value and there's extrinsic value. Intrinsic value is when the option's already in the money, okay? So if NVIDIA is at $201, which it's at right now, and I click this 200 call option, this is in the money by a little bit. There's intrinsic value. It is intrinsically in the money. It's in the money by 95 cents, by about $1, okay? Because if you were to exercise today, I don't recommend ever exercising, but if you were to exercise and you acquired the stock, this call option at 200 and NVIDIA being at 201, you're in the money by $1. That's what's called intrinsic value. So what the heck? Why is this option worth $16? But it's only value at 1. Well, intrinsically it's worth 1. It's extrinsically worth 15. Why is it worth 15? Well, that extrinsic value, the rest of it is really coming from time and from volatility. So these are some of the other Greeks here, such as Vega is volatility, okay? But, these are not the most important. I'm explaining to you how these work. What you really have to know as a beginner investor, if you want to retire, if you want to achieve retirement, what you really need to do is you just need to have a bundle of high quality companies and know how to generate income on them. And at the same time, a portion of your portfolio should be building and growing. And that can be done through call options. It can be done through leap options. So this is kind of the mindset that you should be in as you continue with this course is I want to get you from point A, let's say that you're at $30,000. And that's kind of like a similar story to me. When I was 18 years old, I was, got into college. I started studying finance. My dream was to work for Goldman Sachs, which I eventually was able to do. My dream was to become a trader. But then when I finally got that job, I realized that active trading and, going to work and being at a hedge fund, I wasn't able to trade for myself. So I was just, working in the field, but I wasn't able to actually have the freedom to travel, to be location independent, to have time freedom. So I had, once I learned these skills, I wanted to leave. So the mindset you should be in is to soak this information up like a sponge, build your portfolio to the point wherever you're starting at today, you can get into the end goal, which is your portfolio generates enough premium income on a monthly basis that's enough for you to live on. That is the goal, okay? And that is achieved by two things. First of all, it's by growing your portfolio more aggressively with some of these more growth strategies that I'm going to cover. And then it's using more income generating strategies as well to kind of have two sides to your portfolio, an income generating side and a growth side. And if you're in kind of the beginner days of your kind of growth story, if you're, sub 6 figures, then you probably want to focus more on that growth. And we'll talk about kind of how you allocate capital and the amount of risk that you can take kind of later on, okay? So I wanted to give you kind of like that exciting nugget of information because that is really, really exciting. It's going to be really life-changing information that I'm going to go over. But here, simply said, to wrap up with this call option, this is an in-the-money call option. It has intrinsic value of $1. Extrinsically, it's worth 15 because there's time, there's volatility, okay? So the more volatile NVIDIA becomes, by the way, this option can gain value just simply from volatility, okay? So when you're buying options and you're buying call options, you're hoping for upside move, but you're also hoping for more volatility. So when things become more volatile and there's more risk in the market, options raise in value. They become more valuable, okay? So the main difference, by the way, with the call option is it's a bet on the upside, and a put option, which I'm going to cover right now, is a bet on the downside, okay? So now let's talk about buying put options in the Retirement Academy and overall to achieve retirement. I haven't used too much buying put options, but I want you to understand this strategy briefly because there is a time and place for straightforward, and I'll show you kind of two examples where I would potentially buy put options. So first of all, let's go over an example, and then I'll show you kind of what I actually did in my own portfolio when I bought put options recently. So look, NVIDIA, in this example, let's say we're going to use September 18 again. We're just going to go to buy put option. Let's say that you think NVIDIA stock will fall down. You want to protect yourself, right? A put option was traditionally made for investors that thought that, a stock would go down. So they would buy a put option because it gives the owner the right to sell 100 shares of a stock at a set price, right? So if you have, tons of NVIDIA stock and you want to, kind of protect your downside, what you can do is you can buy a 200 put option. This means that if it goes 200 or below, you don't really care because you get to put, that's why it's called the put. You get to put your shares to someone else. You're like, hey, I don't want this. You have it. I don't want it no more, right? So you get to do that at the strike price that you choose, right? So if you are kind of nervous about a stock and you buy a put option, you don't have to have the stock, by the way. You can just buy the put option and just trade the put option itself, right? Because you're making a directional bet. So whether you want to protect yourself or whether you just want to make a directional bet, you buy a $200 put option on NVIDIA. You benefit now if the stock goes down, okay? So if NVIDIA at expiration at September 18 is now trading for $150 per share, right? It went down $50 and it crashed. You actually ended up making money because you spent $15, but now intrinsically everything below 200 you're making money, right? And if it's at 150, you have intrinsic value of $50. It's $50 in the money, right? So essentially you were paying 15, but then at expiration your option is worth 50. So you would just close it for 50. So the premium cost or the debit that you pay when you're buying a put option, in this example 15, it's really $1,565 because each option is 100 shares. And then at expiration, if NVIDIA is at 150, you have $5,000 in total value and just sell it for $5,000. That's how a put option works. You pay a premium, stock goes down, you make money, right? Now I want to show you kind of like an example of a trade that I recently made. So I made this trade on Oracle because Oracle was a stock that I believed was overvalued. It was just trading for like insane price level. So here, it was at $243 or $240 per share, right? So I ended up buying a put option. Now, this is, again, something within a retirement portfolio you probably don't want to do too much of. In terms of position sizing, I would say that whenever you're buying a put option, just use 2 or 3% of your portfolio, no more than that, because the risk is whenever you buy a put option, you're spending money, the stock does not go down, well, you end up losing the premium that you pay. And that's not a good way to retire if you keep losing money. So a better way is just to use a smaller portion of your portfolio. And when we go over technical analysis in this course, you will see kind of how I make a decision when I want to buy a put option or when I want to buy a call option, or simply what direction do I think a stock can go? What is a more likely direction, right? So let's go down here. I'm going to go into my history because I just want to show you how I ended up playing Oracle. So I'm going to go to kind of show more here in terms of history, and I'm going to show you how I ended up scaling into a buy put trade. So on June 3rd, 2026, I ended up buying a small amount of Oracle 230 puts, okay? What that means is I thought that it would go to 230 or below. It was trading at 240 as I just showed you. So I bought a little bit of 230. Same day I bought more 230 and then even more 230. Now, why do you see multiple buy orders all on the same day? June 3rd, June 3rd, June 3rd, 4 buy orders. That's because I wanted to make a bigger bet on Oracle, but I didn't really want to buy all at one time. I wanted to kind of diversify throughout the day. Okay, so I do that often because in one single day, in a short amount of time, an option is very, very volatile. There is a lot of volatility and fluctuation in the price. Okay, and because this was a shorter bet that I was making that Oracle would fall in a shorter window of time, because I was using technical indicators, which I'll show you later in this course. And in my program, I use technical indicators to make better decisions, such as Bollinger Band as an example. We'll keep it simple for now. But I ended up dollar cost averaging, buying multiple puts. As you can see, it was like 744, 1122. I'll put the math on screen right here. You'll see how much I spent, but I'm going to do a rough estimate that I spent 13, 14, like $15,000. I'll do that rough estimate right here on the screen. And then you can see on June 5th, I ended up closing this trade for a total net, gain of $22,400. So if you do the math there and you take what I sold, $22,400 minus the $15,000 that I'm doing roughly, my profit was essentially a little bit over like $6,000 or $7,000. Okay. So here's the main point. The buyer pays premium and in exchange receives a right. The seller receives the premium in exchange takes on an obligation. Read that again in your head. The buyer is paying for a choice. Okay. So when you pay money, you have a choice. The seller is getting paid to give up a choice, to be on the hook if the buyer decides to use their right. So one side holds the option, the other side is obligated to honor it. That is the whole dynamic between buying options and selling selling options. So let's lay out the 4 basic positions in option trading, because these 4 is basically everything that there is. So these are the 2 different types. There's calls and puts. Now there's buying calls and there's buying puts. There's also selling calls and selling puts. And these are the 2 next strategies that I'm going to cover, because when you sell options, you can either use it to sell aggressively and in a risky way, or you can also sell an option on a monthly basis, collect premium, and use it in a very passive income approach. All right, so let's get into the next strategy, which is selling put options. This is actually one of my favorite passive income strategies. So whenever you're selling a put option, what you're saying is you don't think that the stock will fall down to that strike price. For example, let's watch this on the screen right now so you can visualize how selling a put option works. Let's say that a stock is trading for $120 per share, and you want to own the stock, you like the stock, but you don't really want to buy it for $120. So what you instead choose to do is you sell a put option. You sell a put option at the 110 strike. This means that you're comfortable buying the stock for $110 per share, and the premium that you collect is $5. That means on the chart, as you can see, that your strike is 110, however your break even is 105. So what that means is if the stock ends up going down to 110, you will have to buy, but your average cost is 105. Average cost and break even are pretty much the same, because if you get assigned, your average cost is effectively 105, since you get assigned for 110, but you have $5 that you collected. And that is also your break even price. So they are equivalent. Now, the way a sell put works is you can't make more money than what you collect for premium. So the $5 that you collect in premium is the maximum that you can gain. Your maximum loss is actually pretty much a lot. However, let me explain. The maximum loss rarely ever happens. That's because the maximum that you can lose in this example is actually $105. However, that would mean that the stock would have to go down to 0. So yes, if it goes down to 0, you end up losing all of the money from your strike price minus your premium. But what's more likely to happen in the case of selling put options is that if you pick a high quality company that you want to own, it's probably not going to fall that much, right? And most times, let's say that you sell a 30 delta option, a 30 delta put option, that means 30% of the time you'll get assigned. And that also means that 70% of the times you won't get assigned. So 70% of the time, you're just going to collect the premium, and that's it. That's pretty much the passive income side of the equation. The other side of the story is 30% of the time you're going to get assigned. However, if you pick a high quality company that you want to own, that you don't mind getting assigned on, then essentially 30% of the time that you get assigned is not really something that I would view as a loss. Although technically you're down if the stock goes below 105, then you are losing money. However, if you like the stock, you end up getting assigned, you can hold that stock, and essentially now you just have shares. So you can use selling puts in 2 different ways if you're looking at it from a retirement perspective. From one angle, you can sell puts and you can just generate income, right? You can just generate the premium from the option that you sell. I personally had a student named Denny who I taught many years ago now. I've coached over 2,000 people throughout my personal career. But, this was a story that I still remember, because I remember that Denny was 64 years old and he had a $200,000 portfolio. And essentially his goal was to have income. He had a goal to have income. So, he wasn't really working. He was already retired, but his portfolio wasn't that large and he wanted to spend more time with his wife. He wanted to take care of his farm, his house, and kind of, live that more peaceful lifestyle without having to worry about, finances so much. So when I was working with Denny, he had a very low risk profile. He couldn't really, risk that much because, obviously he was already pretty much in retirement and his nest egg was $200,000. So he had to put his nest egg to work as efficiently as possible without, taking on excessive risk. So we had actually only done a selling put strategy in his portfolio and literally nothing else. So his entire portfolio was just 100% selling puts. Now, some people think it's risky to be within just one strategy, but the thing was we had diversified very well. So we were selling puts on 10 different stocks and we had picked stocks within different sectors. So he had some tech stocks. He also had some healthcare stocks and consumer stocks. At the time we were doing Starbucks. Starbucks was a very, stable stock a few years ago, still a decent stock right now. And we were just selling put options. And there was months where he had $4,800 in premium income that he collected. And across the board from, my experience, what I saw with him from working with him over a 1-year time period, there we were somewhere in that $5,000 income range of premium that we were collecting. And because we were selling out of the money options, because we were going for deltas that were 25 and 30, which by the way is my sweet spot. I like 30 delta. And we were selling options in those ranges that most of the time we were successful. We didn't have too much to manage. A majority of the time we were using proper technical analysis. And despite selling deltas that were around 30, we had a win rate with Denny that was over 85%. So 15% of the time we would get assigned assigned, and then, we would either sell the stock or we would do covered calls, which we'll talk about next, what you do with selling puts. But, it was fairly easy to manage. We didn't have too much work because the majority of the time we were able to win off of a sell put strategy. And, Denny's still in a very comfortable retirement right now. Although it's not a luxury retirement, he has a pretty comfortable retirement. So that's kind of how I would use selling puts as a strategy for premium income generation. Now, sometimes when you get assigned, you might change your mind on the stock that you're selling a put option on. And that can be, kind of the worst part of a situation and a risk to an investment thesis is if you like a stock, you sell puts, but then something fundamentally changes with the stock and now you no longer like it. Well, in that case, then you can close a put option. I don't really do that often because I'm typically investing in high quality companies. Many of them are Mag 7, but something like, I was looking at Netflix recently. Netflix just can't find any buyers. I don't know why. It's a great company, but the stock continues to go down. As you can see on the screen, here's Netflix is basically taking a free fall. So I did have a student recently in the Retirement Academy where we did Netflix, and his portfolio is looking really great, but he personally doesn't like Netflix anymore. He, doesn't like where the management is leading the business. So we ended up, taking a loss by closing a sell put position for a loss. Now we're no longer going to be selling puts on Netflix. So in a way, if you no longer like a stock, you don't have to get assigned, right? Because again, I said you want to sell puts on stocks that you like, that you don't mind getting assigned. That should be kind of a great retirement strategy for anyone looking to, get premium income, but also get assigned on stocks that they like. If you no longer like a stock, you can close out before the option expires. So you don't have to hold an option until expiration. You can close a sell put position before it reaches, expiry. At any time that you wish, you can close it out for a gain or for a loss, right? So, I don't see the point of closing out for a gain just because it doesn't make sense. Like, let me show you. So here I have Netflix. It's at $71 per share. The last 3 months is down 22%, right? Let's go to trade options. I want to show you kind of what this is going to look like. So if I go for August 21st, right, and I sell a put option, let's say that I sell, the 70 put option here, okay? I want to show you kind of the payoff chart here because this is really important. Say that, Netflix trading at $71 per share over the next, couple of weeks before 8/21 expiration, the stock slightly goes down, but it's still out of the money, right? So let's say that it goes down, but if it's still out of the money, then you have a profit, right? You can see the estimated profit is $355. But there would be, in my opinion, no point of really closing out a put position, even if you have a gain, because if it's out of the money, all you have to really do is wait, and then you have more premium that's going to, decay, and more of that decay is just more money that you make. So typically, whenever I sell a put option, I don't see a point of, closing it out early. I'll show you an example of positions that I already have open where you can kind of judge for yourself. So let's say that actually this kind of shorter term QQQ trade that I have could be interesting to look at. Let's go look at this real quick. So this option right here, it expires in, so 6/26 is the expiration. I sold it on 6/24. This is like a shorter term strategy I can discuss later on as a retirement strategy as well. It's riskier, but I did a shorter term trade on QQQ, and today it basically expires. And as you can see, I'm up $1,300, which is great, right? You would kind of think maybe you should take profit, but in my opinion, it doesn't make sense to take any profit because right now QQQ is trading for $725, literally $725, and this put option is $705. So it's very, very far off. It's not even close to $705. It's $20 off. Yet this option expires today, and today, basically, if it doesn't go to $705, which is kind of unlikely to happen, then I'm not going to be up 23%. This option is just going to expire totally worthless, so I'm going to be personally up 100%. So there's no point of me closing this out for a gain when the market value is $4,380, and by doing nothing, literally nothing, I don't have to do anything, just chill, right? Then this option is going to expire worthless, and I'm going to collect the remaining $4,380. That's why it's, closing a put option doesn't really make sense unless you think it's going to crash. Like, unless you think that a position is going to just like absolutely go down a lot. Let's go to IREN right now. It still wouldn't make sense to me. Let me explain why. IREN is currently trading for $52 per share, right? I have a sell put strike price of $50, right? I have a sell put 50 on IREN, right? So let's kind of scroll down here. You can see that I'm down on this option. However, what you'll notice is this is an out of the money option. This option is not in the money right now. IREN is trading for $52 per share. This sell put is a 50 strike price. And this sell put position is worth $5.30. Currently has absolutely zero, intrinsic value. It's not worth anything if someone wanted to exercise it today. It's not worth anything right now because it's not in the money. So the entire value of this position right now is just time value, aka time when it passes this option will just decay, right? So if I go to simulate my return, you'll see that if the stock doesn't move anywhere, right? If it stays at 52, even if it goes down, right? If it goes down, and I scroll down here, the price here on the bottom, if I go down to 51 or $50 and change, this option, although it's showing a current simulated return that would be negative, at expiration, it's still going to lose all of its value. If the option is not in the money at expiration, it's not worth anything. It's going to be worthless. So when I sell an option, I collect premium, which is like pretty much, I would say, the best option retirement strategy is to sell options that are out of the money that, over time they become worthless, and that money is yours. That income premium becomes officially yours and it's realized, right? Whenever you sell a premium, cash enters your account, but it's not a realized gain until the option expires, right? So whenever you close it, that's realized profit. Until you close it, it's unrealized. Okay. So here, like with IREN, it's at $52 and this sell put that's at 50. This is all just like extrinsic value. And because I have sold it, as long as this option stays out of the money, then this premium will decay and this money becomes mine. So I'm showing a total loss right now. And let me explain to you, a lot of investors, they make the mistake of thinking like, okay, I'm down in this position, I'm losing money. Well, technically you're not losing money yet. You're just theoretically losing money right now if you were to close the position. And the reason why this position is down is because it's more likely to expire in the money. It's more likely to happen, right? It's kind of like a bear that is like really, really far away. Your chances of it attacking you is like not that high compared to that bear being closer to you. Like if the bear was in the room, then there's you have like a delta of like 99, right? Like the bear's going to attack you as long as it's not if it's a trained bear, it might not attack you, right? But if it's a wild bear, you have a high risk. If that bear is like 5 houses away from you, then maybe your delta is like 60, right? I mean, the bear sees you and might attack, but it's not close enough so you can like kind of walk away, right? If it's super, super far, then your delta is very, very low, right? So the reason why this option is showing a loss is because the bear came closer, right? It was 5 houses away. Now it's 4 houses away. I'm down money. It's not in the money. Like it's not attacking at the moment, but it's closer to potentially attacking, right? So that's kind of like how options also lose money, is when the potential for a loss is higher, right? So here I'm out of money, but the potential has increased because when I sold this option, I did this on June 8th, and actually a lot of time has passed, but this option is still, because IREN has probably gone down in this period. So let's see, from June 8th, how much has IREN gone down? Because that'll tell us. So from June 8th, okay, so June 8th, the stock was $58, $59. Now it's $52. So it has gone down. And actually it has gone down a lot, from like $59 to $52. That's a $7 fall. And I'm not down that much. And I'm still out of the money. So I'm not going to be down if IREN doesn't fall further. It's actually what I like about selling put options. I look for stocks like IREN because it has high volatility. Okay. So if I go to let's go to this option. I want to show you implied volatility now. This is the next important lesson that you need to learn. You can see here the IV is 111. Holy moly. Like, holy guacamole, extra, beef with fajitas and corn and sour cream on the Chipotle burrito. Like 111, you have no idea. That is insanely high. That is a high IV. Okay. Now, IV is important because, as I mentioned earlier in this course, implied volatility is basically linked to how much an option is worth. The higher implied volatility goes, the option increases in value. Okay. So when you're buying options, it increases in value. When you are selling options, if the volatility goes up, you start to lose value because the option becomes more expensive. And when you sell an option, ideally you want it to go down. You want it to decrease in value, right? But if it's already high to begin with and you sell a put option when it's high, that's a good thing because that's going to be an expensive option. The option is pricey. It's expensive. So I ran here 111 IV, or stands for implied volatility. Wow. And that's why I'm selling options on IREN. Now I want to show you, like, for example, like low volatility. That's going to be like McDonald's. And you can judge for yourself, like, what a big difference it is. So McDonald's is a stock that I like because like 1 year it's down. It's at a 52-week low. The stock is really, really low. So when I go over technical analysis in this course, you'll see that I like McDonald's because it is fundamentally cheap and it's technically cheap on 2 different levels. So fundamentally, the business is strong, but the valuation is cheap. And technically, on the technical chart, it's just very, very low on multiple different indicators. So this is a stock that I really like right now. And I have a position, and you can see a sell put. However, if I go into my sell put position, which I'm up very little on, like $20, that's fine because this is an out of money option still. But you'll see that the IV here is 20. It's so low. Having an IV of 20 is pretty low for income generation. If you're looking to just collect income, premium every single month, and you sell an option like this, you have to put up a decent amount of capital. I mean, this is a larger position where I'm not collecting that much. So why would I do this? Well, in a retirement portfolio, I'm not only chasing premium. That's a huge mistake, right? If you're an investor that just wants to chase premium and you only care about high premium, well, you're going to make mistakes because you're going to pick stocks that only have high premium. And oftentimes there's a reason why it has high implied volatility, right? It has high premium and high implied volatility, but the stock is most likely riskier, right? Because risk and return are correlated. They're They go hand in hand. The higher the return, the higher risk that you're taking, right? So I like to mix in, especially when I'm working with retirement academy students and I'm, evaluating a portfolio, and my goal is to, allocate capital efficiently while also not taking on too much risk. That includes, putting in positions like IREN that are high conviction plays, but also positions that are like McDonald's where, we want to enter into a position, maybe it's not that much premium, but we're using this as a stock entry strategy. Because again, when you're selling put options, your goal is, to enter a stock potentially for the price that you want. Okay. So I just wanted to point out that implied volatility here on McDonald's is extremely low, and this is not that good, but it's still okay because you're looking to get into the position and you want to get assigned. So you're just using this as a stock entry strategy rather than a pure income generating strategy. All right. So now I wanted to show you an example of selling a put option live, and I'm going to actually execute on this trade. So right now it is pre-market. The market's not open yet, but I'm going to set a limit order for selling a put option at the strike that I want. So I'm going to be using Palantir just because Palantir is a really amazing company that's growing very fast. However, it has recently fallen a lot. So I see this as a really big opportunity at $112 per share. So what I'm going to do is I'm going to go to trade options. Okay. And I'm going to go for July 17. Now, what I like to go for is traditional expiries. So the third Friday of every single month is a traditional expiry. That's why you'll see July 17, August 21st, and then you skip to September 18, October 16, November 20, December 18, January 15. These are all third Friday expirations, and these are the traditional expiry dates. So I'm not sure why. It's just basically there's more volume and there's more interest in these option positions because options are usually on the third Friday. But in the shorter term window, you'll see that there's many more expiration dates like July 24 and 31 and August 7. That's because in the short term, more option expirations open up, but in longer term, it's really the traditional Fridays. Okay. So let's go for July 17, which is a traditional Friday, and I'm going to go for a 110 sell put. Now, I mentioned to you that my sweet spot is 30 delta. However, when I want to basically get assigned into a stock and I see a really huge opportunity, I am comfortable going for higher delta. Let me say that one more time. The reason why I'm comfortable going for a higher delta when I really want to enter into a stock is because a higher delta is going to give me the benefit of higher premium and higher assignment risk. And in this case, I want higher assignment risk because I'm ready to buy more Palantir stock. Also, keep in mind the bid-ask spread here is absolutely gorgeous. It is beautiful because $395 bid and $405 ask is only a $10 difference. I'm probably going to be able to get filled for the mark price or the middle price of $4. So if I sell this put position right here, I'm going to collect $400 per contract that I sell. Okay, so I'm actually going to enter this trade. I'm going to click continue. You can see here based on the payoff chart as well that essentially at 110, that's my strike price, but my break even is lower than that. My break even is 106 because I'm collecting $4 worth of premium income. So my break even is 106. It also means that even if I get assigned at like 110 and Palantir's at 109, and let's say I get assigned on Friday and Monday I have shares. Well, if Palantir is trading for 109, my average cost is 106. So I can get assigned and still be at a gain. These are not mutually exclusive events. They can both be true at the same time. I can get assigned and I can still be up on the stock because the premium that I collected, compensates more than the money that I lost by being in the money. So if I'm in the money by $1, but I collected $4 of premium, I can still be up $3, still be having a profit. Now, I also had this situation happen to me many times, and I love this situation. And whenever I'm working with students and they get assigned, sometimes they are like, they might be slightly upset. They're like, hey, I got assigned, Henry. I'm using my capital now. And, they might write that to me on Saturday because I do one-on-one coaching in my program, the Retirement Academy. You have access to me anytime. You can write to me anytime. I'm there to support you throughout your entire journey. That's what I am as a coach. That's what I love to do. That's my mission and purpose here in this world is to help more people, achieve retirement with option trading. So, of course, if you ever want information on that, I'd love to be your coach. This is something that I'm absolutely the best at in the world. I've been coaching for over 6 years now. So anyways, when they message me on Saturday, right, my student might be like, hey, Henry, I'm using a lot of capital now and I'm in the money, right? But I'm like, hey, hold on. We did our technical analysis. We like this stock. I remind them and they're like, yep, you're right. Monday happens, right? For example, on Palantir, you get assigned to 110 because the stock went down to 109. Monday happens, stock's at 115. All of a sudden, the students message me, oh man, the stock's up a lot. What do I do now? We'll talk about what to do then. That'll be the next chapter of this course, which is covered calls. But essentially what I'm saying is you can get assigned, you can be up because the premium that you made is more, and then you can also be up because now you have stock and the stock can go up, right? So anyways, let me hit continue here. I'm going to, I like this stock. I'm just going to do 2 contracts here. Now I'm going to enter a limit. I'm going to enter see there's a stop limit to get out or a limit to basically kind of get in here. So I'm going to go for, I want to, today I'm going to kind of sell this position and collect the premium. I want to collect $4.15. If Palantir has some volatility, this option position might open up more. Again, I'm making this video pre-market. So if it opens up at 415, I'll get 415. If it opens up and it's not 415, then, this option won't get executed. But, when the market opens up, I'll decide live on the spot as the market's trading if I still want to make this trade. And spoiler alert, I do want to make this trade regardless, but I just want to show you what a limit order looks like. So I'm going to review this trade and, okay, I don't have enough buying power, so I'm going to have to actually clear up some of my current positions. But anyways, when the market opens up, this is a trade that I am going to place and I'm going to actually execute on. Covered calls is an amazing strategy that I have used in my own portfolio. And an interesting story is back when I was in college, I talked to a financial advisor who was managing NBA player money. He basically had several NBA players, and I forget which team it was for, but I remember him telling me that the primary strategy that he uses for all of their portfolios is covered calls. And at the time, I wasn't really an expert at covered calls just yet, but I had understood that basically a covered call is when you sell a call option on shares and you give up your upside. And I had asked this financial advisor, why would you give up upside? At the time, I was probably like 19 or 20 years old. And I had thought like, hey, NBA players have all this money. Don't they want to grow this money aggressively and kind of build their accounts even more? And the financial advisor basically explained to me, and he said that he uses covered calls for 100% of their entire portfolio. And I was so confused. I was so baffled. Like, a covered call gives up upside. What's the benefit? And he had explained that a covered call generates income because you sell premium, you collect that money into an account, and yes, you give up upside, but it doesn't mean that you give up all of your upside. So at that point, I kind of understood what he meant, but I still didn't understand why he would do 100% of the portfolio. And he kind of broke down the math for me. So he said that if a portfolio has, for example, $100,000 and you sell covered calls on all of it, but you leave yourself 5% room for upside in terms of capital appreciation, right? So imagine a stock's at $100 and you sell 105 call options and you collect $5 worth of income, okay, in let's say a 3-month period. Well, what that would look like is that if a stock goes up, you still benefit if the stock goes up until 105, right? Because that's the call option strike price. And as you can see on the screen, okay, in this example, if a $100 stock goes to $105, you can still make money up until 105. And because you collected $5 worth of premium, that means that your break even is 110. So that means that the benefit that you can get from a covered call is still up to $110. And you pick a 110 strike price that expires in 3 months, well, in most cases, a stock will still not go up to $110. And if it does, hey, that's fine. Going from 100 to 110 is a 10% gain. And if that happens in a 3-month period, that is still a return that is super attractive to a majority of investors, right? So then the story started to make sense for me. Why would you give up upside? Well, you give up upside because you collect upfront premium. The upfront premium is already locked in. So even if the stock ends up falling down, let's say that the stock goes from 100 down to 98 and it loses $2. Well, a stock investor would suffer a $2 loss, right? They would lose money. But someone who has sold a covered call at a 105 strike price gave themselves room for upside and they collected $5. That means that their break even or their average cost went down, okay? So if they have a stock at 100 and it went down by 2, all the stock investors lost $2. They're all upset, right? They made not no money, they actually lost money. Whereas someone who sold a covered call in that 3-month time period, they ended up having a $5 gain. The stock is down $2. They still have a net gain of $3 per share. Or in essence, a $100,000 portfolio in that 3-month period would be worth $103,000 even when the stock market went down and everyone else lost money, and everyone else's portfolio who did not do covered calls, now their portfolios is worth $98,000. But a covered call investor would have a $103,000 value, where just a stock investor who did not sell covered calls has $98,000. So essentially, the premium that you collect reduces your overall risk, still allows for upside, and in the cases that the stock market goes sideways, premium is yours. If it slightly goes up, well, you still get capital appreciation. The only time that you really lose on a covered call, the way that he explained it to me, and obviously this is a long time ago, and now I've done this strategy so many times that I have generated probably maybe even 7 figures worth of value in my own portfolio, definitely multiple 6 figures. But essentially, the reason I love this strategy so much is because it has so many benefits. The only time that it really loses is if the position just explodes up. So of course, you would not want to use a covered call on like a highly explosive stock. Say Nebius. Recently, Nebius went up so much. It's an AI stock that I personally like a lot. If this stock went up from like $200 to $280, then yes, if you ended up selling a covered call at 210, you would have left all that upside on the table. It went from 200 to 280. You got a benefit till 210. And then all that $70, oh man, that sucks, right? That's FOMO right there. You left all that money kind of just up for grabs. You didn't collect it. Yes, agreed. Covered calls are not going to be the best, overall position for 100% of the portfolio. And what the NBA advisor was telling me was that a lot of the NBA players, since they're already like really wealthy, they don't care too much about the upside. But as a retirement academy strategy, I do care about upside. I do want growth because many investors that I work with, engineers and doctors, they could be doing well, but they still want growth. These guys come to me with a portfolio that could be $50,000 or $150,000. And covered calls can generate income, but they want upside. So again, when we talk about leaps and poor man's covered calls and generating income on leaps, that's going to be very interesting for you if you're in that stage. But, there is a time and place for covered calls. And I believe in my opinion, the position size that I have in covered calls, 20 to 25% of my portfolio, I use covered calls. That's because, again, a covered call reduces overall risk. A covered call is essentially when you have shares, you sell a call option, you collect income, you give up your upside. But hey, that is reducing your overall volatility. You're generating premium income. And now you have a covered call. The benefit of a covered call is also downside protection. So if the stock goes down, the premium could act as a cushion, okay? And the higher the implied volatility, the more cushion that covered call is. All right, let's look at some covered calls within my own portfolio, and let's actually look at opening up a new covered call position as well. So I have a lot of covered calls in my own portfolio. You can see here, I have a covered call on Fly. I have another covered call on Shopify. I have a covered call on NVIDIA, covered call on Chipotle. Actually, I have a lot of covered calls on SoFi. I have a 19 covered call on SoFi. SoFi is out of the money right now. My previous covered calls actually expired out of the money. So I had 18 covered calls, which ended up making me about $10,000, which I'm very happy about. I have in the money covered calls right now on Robinhood. So Robinhood is a stock that I have recently bought more of. I had mentioned to my community, hey, I want to buy Robinhood at 85. We ended up doing so well on it in such a short amount of time because, Robinhood, the stock just went up a lot. As you can see, the stock exploded up. I liked it at 85 here and went from 75 all the way up to north of $100. And this is kind of difficult because a covered call that goes into the money, and I'll show you kind of how to manage this trade right now. You're no longer making any more money on upside, right? So you might start to think to yourself, well, I want to participate more. I want to make more money. I'll kind of show you what you can do in this case. So in this case, on Robinhood, I'm up $5,000. So I'm pretty happy. I don't really need to do too much, right? I'm happy. Although this is an in-the-money option right now. It's at 95. And because it's at 95, at expiration, I have to lose the stock. Let's talk about managing. This is an important time now in this course that we can talk about managing this strategy, okay? Covered call is pretty straightforward, right? If you're a beginner, you kind of already get that. But now what's kind of like more advanced? How do you manage a covered call that goes into the money, right? Because it's pretty easy when a covered call is out of the money. Yeah, you collect the income and okay, so what? But now in the money, if you don't want to lose the stock, because again, one important piece of information, by the way, and I'm not licensed at tax advice, so seek a professional tax advisor, but if it goes into the money and you lose the stock and gets called away from you, you now have a taxable event. You'll make money, but now you have to pay taxes. It's a taxable event. So one thing that I personally do and that I also teach in the Retirement Academy, because it's not only about how much you make. I have a lot of students that I have helped make 5 figures per month. The majority of my students are making 5 figures per month. I have some students that are making, in the mid digits, like 50K per month and higher. They have bigger portfolios, right? And for them, taxes becomes a lot more important because it's great to make a bunch of money, but then when you see some of that go away, it's not the best feeling. A covered call that goes into the money, a strategy that I use is to roll. And that way I don't lose the shares. So let me show you kind of what that looks like. Scenario though, because on Robinhood, I'm already making money. I'm going to show you a different scenario where I'm losing money because I want to show you how to turn a losing trade into like a winning trade. Whereas with Robinhood, I'm already making money. So a roll won't seem as dramatic to you. You might think, okay, well, this is good for maybe taxes. What other benefits are there? So I want to show you something where I'm actually losing money. Amazon, I have a big gain as well. Google. I'm losing, but it's so deep in the money. Yeah, you know what? We can use Google. This is going to be a kind of a bigger trade here, but there's a lot of lessons learned here. So what you'll notice here on Google, this is a large position. Kind of right off the gate, I just want to show you kind of the whole holistic view so you can understand. I ended up buying Google for $236 per share. That's my average cost. I had told my Discord community, this is what we're doing, and this is a longer term position that we've been in. It's under a year. So considering I made $103,000, the Retirement Academy is definitely something that you want to join because I've been extremely successful at coaching, and the stocks that I pick have been absolutely beautiful. Like literally, this has been life-changing, and this is under a year position. But, I want you to understand the full picture. I have 1,000 shares, 236 in average cost. I'm up 100K. However, because this option is in the money, I am losing money on this short covered call, right? This short covered call is selling a covered call. I have sold it and I am down 27K. So I'm up 100K on the stock. I'm down 27K on the position. So I have like a net gain there of $73,000 on the position. Again, those are the type of stocks that I find opportunities in, and I try to do that every Monday. I look at opportunities just like this. So if you want me to find those opportunities for you, if you want to learn how to do all this and you're enjoying this course so far, subscribing to the video, I greatly appreciate it. Like from the bottom of my heart, it would mean so much to me. Let's continue on here. I'm up $73,000 because down $27,000 on the position on the covered call, but I'm up 103K on the stock. So I guess that's 75K or whatever it is. Now, look, I don't want to let go of Google because I made money on it. If I let go of it, I have to pay taxes. Okay. I also don't want to let go of Google because I like the stock. So how do I manage this covered call trade? What I can do is I can actually adjust the strike price, and it's called rolling. Okay. Rolling an option allows you to close one option and basically replace that with a similar position, but it could be a different strike price, it could be a different expiration date, or it can be both. It can be a different strike price and a different expiration date. So on Google, what I'm going to do, I'm going to trade. I'm going to show you how I can completely, I might not be able to fix this position entirely, but I'm going to show you how I can benefit myself a good amount with the roll. Okay, so I'm going to go roll this position. I can fix it, by the way, completely, but it's going to require lots of time. I'll show you multiple examples. Look, I have a 300 call option. You can see it's worth $54. So if I just close this option, I could do that as well. I could just close it and it's $54. That's expensive. That is going to cost a lot of money, okay? I don't really want to do that. Instead, I want to roll, okay? So if I roll and I pick a future date, right? So let's say I roll to January, right? So instead of September, I go for January. So I can, first of all, just look at the premium here. And you can already see that 310 call, it's $59, okay? So now you can see that I can move from 300 to 310. That doesn't fix my situation completely. I don't become out of the money, right? Google's at 340. However, this gives me more time, okay? So I don't have to sell the stock at September. I can sell it into January. That's a different year, different tax year, first of all. Second of all, I'm just pushing this down the road, right? I'm pushing this into a future date. Okay, so going from 300 to 310, now I'm pushing out the time period. And because time is money, as we talked about in the beginning of this course, I'm actually collecting a credit here. This option is worth more. Okay, so the debit I have to pay is 54. The credit that I get is 59. So you can see this total roll will benefit me. I will make $5,650 in this roll. In this example roll, I will collect a credit of over $5,000. So I will make over 5K. I will push this out to later dates. However, can you spot the biggest benefit is that the strike price is different. The strike price, I'm not going from 300 to 300. I'm going from 300 to 310. So that is also a benefit to me of $10. Because I have 10 contracts here, I'm getting a benefit of $10. I actually get a benefit of $10,000 here because the credit that I make is $565, but the step up in strike price is $10,000. $10 per contract, but $10,000 in value. So my total net benefit is $10,000 plus the credit. So I'm benefiting $15,000 with this roll. What does this cost me? Well, it doesn't cost me any dollars. It costs me time. It costs me 119 days. Great, 119 days, but I get a benefit of over $15,000. Count me in. This is a trade that I'm looking at doing myself. I like this trade a lot. So this would still be in the money, and I'm making $10 because Google's at 340. So it's well above this mark. It's well above 300. It's well above 310. Technically, Google can fall below 310, and then I would start to lose money. but there can be a lot of volatility. But this right now has intrinsic value. This is literally intrinsic value because Google is at 340. So this is one of the kind of examples that you could do. Now, but I want to show you something even more interesting. I mean, this could be less interesting depending on how you look at it, but I just want to show you the difference between going out even further. Because the further you go out, basically I can fix this trade completely. So like I said, if I wanted to, I could fix this trade completely, but it's going to require more time. So now you can see here, I can go from 300 to 340. Essentially, Google's at 340. I would go from an in the money option to out of the money or at the money. I completely fix this option, completely. And I also get a credit. I get $3,800. So I get crazy benefit here. In fact, the benefit here, okay, and this is something that I cover in their Options Retirement Academy, is annual return here is something that's important to calculate. And it's essentially $40 plus the net credit I'm getting, which is, call it about $43. And as a percentage, that's really massive because the capital that's being tied up is 300. So the amount of benefit I'm getting is roughly 43. The amount of capital being tied up is 300. So 43 divided by 300, you can see the return that is benefiting to me. And this is happening in 272 days. So more time equals better roll because time is money. So this equals a better roll. The total credit is not better. It's lower total credit, but the total benefit of moving up the strike price is a lot more. Okay, so that's kind of like how I look at adjusting a strike price of a covered call. If it's in the money, then I will look at essentially just increasing the value of the strike price by rolling to a future date. Rolling is very individual based. So if you also want a free guide on rolling, I have a PDF down below that you can also download. It'll discuss kind of when to roll in different situations to roll. Rolling is very kind of complex, but I go over the top 10 situations when it makes sense to roll an option.
Let's jump into the wheel strategy. As you can tell, I'm recording this over several days. That's why I'm in a different area wearing something else. So it takes a lot of work to do these videos. If you appreciate that, leave a like, but let's not waste any time. Let's jump into the next chapter here. And this is an income generating strategy, which I think you're really going to like. In fact, this is the best strategy that I even know of. This is the most consistent strategy that I have used in my experience. It has some weaknesses, but boy, does it have a lot of strengths as well. So we're going to be opening up my portfolio. Here it is right here. I'm going to explain how I and my community, we have been able to consistently make weekly and monthly income. We have done extremely well with this strategy. And think of it kind of like a bicycle. You know how like the tires are like going round and round and you're going towards your destination? Well, that's pretty much the wheel strategy. As long as you're kind of going in this direction like on a wheel, then you're doing very, very well. The spinning never really stops, and that's actually a good thing. So money comes in at every single stage of the wheel strategy. So it has several different steps. Let's kind of just go through step by step here. I'm going to show you several of the positions that I have. Now, I actually have a Google sell put position. So we already discussed selling puts in this course, and the whole first step of the wheel strategy is selling puts. That's what makes it such an awesome kind of system and process, is that it just builds on top of what you already know from going through this course so far. The wheel strategy is actually pretty simple to run. It's not anything complex, it's just a combination of selling options. That's all it really is. So here's a position. The reason why I wanted to open this up is actually over the past 1 month, you can see here that there's been a lot of fluctuation, and this option has been as high as $43 and now it's down to $28. Now, that might not seem like a lot, but at one point I was down tens of thousands of dollars on this position. And as you can see, this position is up $6,000 today. So this is me running the wheel strategy on Google. So what is the wheel strategy? How do you run it? How does it work? And how do you not make mistakes with the wheel strategy? That's the most important part, right? So let's go into a stock right now. I'm going to use SoFi. I just think that SoFi has been beaten down a lot. SoFi stock has been pretty low, and the wheel strategy is really a bullish strategy. So whenever you're running the wheel and you want to kind of produce income via selling premiums, well, you can't just sell premiums and then be like, hey, I made some income, now I'm happy, right? Yeah, it's not that simple. What you need to do is find a high quality stock. Okay, so number one, high quality stock. Number two, not only does it have to be a high quality stock, you have to have the cash to do the wheel strategy. This is a somewhat capital intensive strategy, albeit it doesn't have to be that capital intensive, because as you will see in this example, SoFi is going to require roughly $1,800 or even a little bit less than that when you factor in the premium that will be collected. So let's do this right here. SoFi stock for the last 3 months. And this doesn't have to be stock specific. I'm just doing it on SoFi. Feel free to find a stock that works for you. Again, the most important part is that it has to be a high quality company. You have to have the cash to do it. And now number 3 here that you're seeing on the screen, 1, 2, 3. Number 3 is you must want to actually get into it, because ideally the wheel strategy, again, going back to the bicycle analogy, You are in a bicycle, the wheel is spinning. Well, the first step of the wheel is selling a put, but as we will see, the second part of the wheel strategy is getting assigned on the put. Okay, you're assigned, now you have shares, and then we further on the wheel by doing a covered call. So in step number one, it's selling a put, but you can't even get to step number two unless you actually get assigned. So, kind of in that first step, right? In this first step of the wheel strategy, when you sell a put, essentially you are pretty much waiting. Okay. That's the nice part about the wheel strategy. It's not a whole lot of management. It's not a whole lot of, having to check the position. It's more so making sure that your entry is correct to begin with. Because if you start off correctly, then getting out of the trade is a lot easier. Then getting out of the trade is actually pretty simple because not that much can happen in terms of like a negative events. First of all, if the stock goes down, you get assigned, great, right? You want to own the stock. That's not a problem. So let's kind of go over that first scenario here. So SoFi, I'm going to go to trade SoFi options. And let's say that, I'm happy owning the stock at $18. That is the strike price that I'm comfortable with. Okay. So this is the first step. Just go to sell and then put option. Now, if you want to go for something more like weekly, my community loves weekly options just because when you collect premium and expires on a weekly basis, that's basically like a weekly paycheck, right? So, whether they have a job or, they're already retired, then they get a weekly paycheck. So it's really nice because they know exactly how much they have made during that week. And now they can go ahead and spend that money or they can reinvest it into their portfolio and just continue to scale their portfolio. So weekly can be very exciting, but also monthly is fine as well. So I'm going to go here for an option that expires on a weekly basis. Okay. So, as I'm making this video, it's, we're in July 1st, but if you're watching this in the future, this video is going to take me some time to edit anyways. If you're watching this in the future, just use this logic, this thought process, and the skills that I'm teaching you, the techniques to pretty much just do it for yourself, right? So I'm going to go to sell put option here, 9 days out. Basically, this is a weekly option, right? So I'm going to go for the 18 strike price right here. Now, let me explain to you pretty much what's going on here. And then even if I'm going a little too slow for you, bear with me because this all kind of builds on itself. And if you don't understand the foundation, you will make mistakes later on. And that's going to cost you a bunch of money. So look, this 18 sell put, right? It's going for $41 in premium. Now, this is the premium that you collect whenever you sell this option because we're selling the put option, right? As we learned earlier in this course. So we sell the put option, right? Now, all we have to do is wait. The bid ask spread here, by the way, is beautiful. It's like some Italian pizza with the extra, marinara sauce with some basil on top, a little Parmigiano. I mean, it's just beautiful. It's like a masterpiece here. That's because the tighter the bid ask spread, the better. Really, the tighter the bid ask spread, that might sound funny, but the tighter the bid ask spread, the better. Okay. And that's because every time you trade, you could lose money. Okay. You could lose money if the bid ask spread is really wide. Here in this example, I'm using SoFi just because I also like the bid ask spread. It's amazing, right? Now, okay, so whenever you go ahead and sell a put option, really you just want to make sure the premium is attractive. Now, what's attractive? Well, different things are attractive to different people. For me, I have a hurdle rate. Okay, my hurdle rate, my goal in my community is, and what I have been able to achieve is about 1% per week. And that's what I've been collecting in terms of premium. Sometimes I collect a little bit more. I'll go for 1.5% premium. Now, my end result, there's some risk there. Obviously, I'm not winning every single trade, but I've been pretty much around that 1% weekly target that I've been aiming for, and I've been able to achieve that. So when I look at a trade like this and it's a weekly trade and it's $40, that's basically over 2%. So that already tells me that, first of all, the risk is pretty high here because that's a high return, right? It's not really that normal for someone to be collecting 2% every single week because if you think about it, you do the math, 2% per week is like 8% per month. That would annualize into a over 100% annual basis, which if you think about it, I mean, there's some investors doing that, like Leopold Aschenbrenner, for example, this 24-year-old kid who's been very successful. But you know what I'm saying? Yeah, I think he kind of might be a little bit of Nancy Pelosiing some stuff. Anyways, what I'm trying to get at is Warren Buffett's return is like 20%. My personal return over the past about decade has been annualized to be over 50% in my own experience. And, when you look at something like this, I just want you to be realistic. I want to set the expectations straight. The wheel strategy is a very attractive strategy, but it's definitely not the highest growth strategy. The reason why I like the wheel so much is because it's more of a consistent approach to collecting premium. That's the whole goal with this strategy. I'm looking for consistency. I'm looking to have stability, and I'm not necessarily looking for the largest returns, because if you want the largest returns, that would be more so in the buying section, which we're going to talk about as well in this course later on. But I really like this as more of a powerful retirement approach. So look, the premium here that I'm collecting is 40 cents, which is essentially just a little over 2% on the entire collateral that I'm putting up, as you can see here as well. Now, don't pay attention to the max loss. The max loss is, I mean, that's if the stock goes down to zero. So that's not that relevant. What's more relevant is the capital that you're tying up. Okay, the capital that we're tying up here is going to be $1,750, right? Just slightly under $1,800. And that's just because, I'm collecting 41 and the capital I'm putting up is 1,800. So we subtract the 41 from the 1,800. So we get 1,759 here. Okay. So this is essentially the first step here of the wheel. And then as soon as I sell this put option, I'm hanging out. I'm not doing anything. The delta here is 36. And that's important to us because what 36 delta means that there's a risk or a chance of the probability, any of those three kind of are very similar there, is there's a 36% probability that this option expires in the money. So 36% of the time, you will be getting assigned on this position. And the reverse of that, which is about 65, 64% of the time, you will not be getting assigned on the position. Okay. So there's only two kind of scenarios there, right? Either you're in the money at expiration on July 10th or whenever your option, personally expires. Then if you're below the strike price, you get assigned. Then you move over into step two of the wheel. If you don't get assigned, well, I guess, that's not really a bad thing. When I think about it, right? A lot of people are like, well, I didn't get assigned. Well, what now? Nothing really. Just rinse and repeat. Just rinse and repeat. Just like hand over fist it. Just do it again, right? But if you do get assigned, then nice. Now you get to move over into the second part of the wheel strategy. So let's say that we have the shares now. Okay, we have shares. We have gotten assigned. The stock is up, 3% today. Let's say, right? So the stock's at 1848. Well, now what do you do? Well, now you go into the second step of the wheel strategy. So let's say that we already had gotten assigned. We have 100 shares. We got assigned at say 18. You can be 19, 18, whatever, somewhere around this current level. You just sell a covered call, right? And the most interesting thing is there's also $41 on the covered call itself. So there's $41 on the sell put. And interestingly enough, there's also $41 on the covered call. And it's actually not by surprise. This is not surprising at all or unexpected by any means. And that's because options are pretty similar across calls and puts in terms of value. So because SoFi is at 1850, it's only 50 cents to 18. It's also 50 cents to 19. It would make sense that the sell put and the covered call that are both 50 cents away are about the same in value. That's because the stock market typically does not take a bias towards direction. Let me explain what I mean by that. So SoFi is in the middle and stock market is very random, right? All these YouTubers and gurus saying this stock's going to rise and that stock's going to fall. It's very, very difficult to do that. In most cases, in the short term, nobody can do that. Okay. So instead, you can see here that even the options market, they pretty much know that the game is, pretty random, especially in the short term. So what options are basically valued are something called the Black-Scholes model. And to get really simple into it, okay, it's just super, super beginner without having to go on the high level. A Black-Scholes model is basically trying to tell you the average fluctuation this option can experience, which is basically risk, volatility, fluctuation, risk, all the same thing as well, right? I just want you to really have a deep understanding here. And the premium here is simply what you get paid for taking that risk. So if you have 50 cents away from both sides, you have about the same risk. Therefore, the premium is about the same. Yeah, that's awesome, right? All right, so look, sell call 19 here. I'm going to expand this. And again, the delta is very similar. So again, going back to risk, the risk here is pretty similar. It's a little bit higher, but not by much, not meaningfully. There's a 38% chance here. In the other example, there was a 35% chance. So the difference is 3%, which is meaningful. It is meaningful, but it's not meaningful enough for the premium to be that different. Okay. So keep in mind, again, this is a attractive premium, right? You can get my hurdle rate and my attractive premium rating in my Discord community. What I usually do is I show you based off of this, the annual return that you basically get. And we form a hurdle rate every time someone joins the Discord because people will have different goals, okay? Depending on the goal that you want to achieve. So some people want to retire within, 5 years, while other people, they understand that, maybe I need extra time because my portfolio is smaller. It doesn't really matter where you are, but we always set a goal and a hurdle rate whenever, I start working with someone and someone enters into the Discord community. That's very important because the higher your hurdle rate, which is basically the higher annual return that you're trying to go for, you may have more volatility, which is just a given, right? Because risk and return are very kind of similar, right? The more risk that you take, the higher expected return that you are assuming. So in terms of selling this call option, this 19 strike price, look, getting down to the wheel strategy, this is pretty straightforward because if SoFi goes to 19, you let go of your shares. If you got assigned at 18 and then you get out at 19, we don't even need to think about premiums. We just know that we got assigned at 18 and we got out at 19. Simple enough, right? Great. That's how the wheel works. Selling puts, you get in at that strike price. Selling covered calls, you get out at that strike price. And that is the system, that is the process that you go for. Then you have to calculate some premium. Premium though is pretty much gravy as long as you're getting in and getting out for lower and higher amounts. Now that might seem hard, right? Because a lot of people are like, well, it's easy to say get in low, and you know how they say buy low and sell high. Well, it's not that easy, right? All the time. That's true. It's not that easy because a lot of stocks have volatility. But let me tell you kind of the easier part of things. If you have a high quality company, which by the way, I do for you within my Discord community, I'm always looking for high quality companies. I'm looking for valuations. And although I'm not correct all the time, if you pick high quality companies, typically they are going up over the long term, right? The S&P 500 in general goes up long term, right? The stock market is a kind of it rises over the long term. So when I look at selling a put option, if you go for an out of the money sell put, right? It's out of the money. It's not at the current level. It's lower than the current level. Great. That means that you're getting a discount because you're selling a put that's lower than the current price of the stock, right? So awesome. Now, in terms of like a covered call, because you sell a call option also higher than the current price, if it's out of the money, that basically gives you a huge advantage, like a massive, massive advantage. Now, I'm not saying like this is like, the greatest strategy that builds an account to the moon, but this is a strategy that I have used for 10 years. Like literally, if I do the math here, right? If I have a portfolio that's like 190K, right? Then I'd be able to do a lot of this. And okay, let's actually go to here. Let me actually click continue. So if I could just do like 1,000 shares, then obviously, oh, that's 1,000 contracts, excuse me. If I could do 1,000 shares here, that's not like crazy amount. That's not a crazy amount of capital. That'd be like roughly like 19K of capital. And this is what I would in terms of premium in like 9 days, right? So, as you can see, it's very scalable. So if I were to grow my portfolio to like maybe like the 6 figure mark, then I would do like this, right? And if I look at this as like a weekly thing, then man, there's many countries where 2K could go very, very long way, right? Majority of countries that are non-Western, not United States or Australia, you could like move and like freaking have a lot of freedom, right? You can have a ton of freedom off of this. So when I look at the wheel strategy, I'm really looking for like what type of return am I getting? I'm not always looking for the craziest return, but I also don't want to have a low return either. Like if I go to a less attractive stock, something like Coca-Cola, I'm not going to waste time to do it, but basically if I were to go to like a low volatility stock, it's not going to produce enough premiums for it to really be like worth it. Yes, I can make money, but it's not worth it for me to like make pennies even on a lower risk strategy, right? Because this would be considered I would consider this a lower strategy. Now, why would I consider it a lower strategy? It's because I actually call the wheel strategy a non-losing strategy. I've been teaching this for 6 years, and I had a lot of students that have graduated through my program, where I'm still working with, and a lot of them just choose to just stick to the wheel. Now, you can feel a lot of FOMO when the stock market is like ripping higher by like very high amounts, like in the AI momentum market. It can be difficult, but also you don't need to use the wheel strategy for the most of your account. Like you wouldn't want to do that anyways. You still need to diversify and have different strategies in your portfolio, which is exactly the point of this course. We have multiple different strategies, and the strategies that I'm going to teach you later in this course are going to be, I would argue probably even more effective, especially for someone that has like smaller capital and is looking to grow. So if you want to grow, then that's going to be pretty much the next chapter here. But this is also very important because you should learn how to run the wheel, even if you have smaller amounts of money. It's pretty much like that saying, like, learn how to take care of a dollar bill before you can learn how to take care of a 10 bill. And then learn how to take care of the $10 bill before you can learn how to manage the $100 bill. Whatever. I'm, yapping here, but you have to learn how to do the wheel strategy on smaller amounts of money and then kind of scale up and build up. You can't be like, hey, I need a big account to run the strategy, because that's not the truth. The truth is that you don't need a big account to run any option strategy. You can always pick cheaper stocks. SoFi being a good example where you can run the wheel strategy without even needing a couple of $1,000s. So you can just literally do it with, $1,700. That's enough capital to basically start running the wheel strategy on SoFi. So this is the second step of the wheel strategy, where you sell calls. And look, if the stock goes above your strike price, essentially what you do from there is is really nothing. You let it get called away. And majority of cases, you just let it called away. Now, we went over like an example here. I will actually want to go through some positions that I currently have. In my Discord community, I am always talking about American Airlines. Man, have we done super well with American Airlines. This stock, I'm going to show you like, I can't believe I'm giving this away for free. Uh, can't believe it. But, you know, I want to give you guys a lot of value. American Airlines right here. I'm going to go over my bread and butter. This is really like, this is this is the I'm wearing a long sleeve. This is the bicep over tricep. This is like the high protein, highest quality, kind of setup that I have found in my entire career. This stock has been not the highest growth stock, but man, have I collected the most consistent premium that I have on any other pretty much position. Even though I made a ton of money myself on Tesla, I turned 100K into 700K back in 2021. And that year was my most successful year, not only personally, but coaching wise as well. We had so many students that have, entered the 7-figure mark from not even starting with that much. They came in with like 50K, and then within like 12 to 24 months, these guys were like 7 figures. And then it's crazy how much wealth is created in the stock market. It really is. It's so life changing when you really learn this stuff on a deep basis, how life changing it can be. It is really remarkable. In American Airlines has been a huge part of it. Actually, let me show you something. Let me zoom out a little bit. Let me go to 5 years. The stock has done nothing. It has done nothing. Yet that is the most beautiful part. That is literally the most beautiful part when a stock does nothing. Because if a stock does nothing, but you're selling options and you're doing the wheel strategy, and a stock doesn't go anywhere, but it has a lot of volatility, like you can see the volatility, like it's just up and down, up, then down, up, then down, up, then down. I mean, it just repeats. Like this is the most repeatable stock that I've just been trading in my community. Just rinse and repeat. Like my members are like, Henry, this is easy. This feels easy. I'm like, great. I don't want it to feel hard. Maybe there's other things that are life's hard, right? There's many things that are hard, but if I can make your life easier, why not? I want to do that. So airlines, and man, this stock, every time I sell puts, sometimes I get assigned, and that's fine because there's always a strong support. I always say my support for American Airlines is $11, and throughout past 5 years, by the way, 5 years is enough to basically pretty much retire. I mean, 5 years is pretty much, to be honest, it's pretty much enough. It's pretty much enough if you do the right things. If you do the right things, stick to the plan, have consistency, have an awesome mentor, have good guidance, don't make big mistakes. 5 years can be enough. And if I look at American Airlines, it's been enough. Obviously, I haven't put in more than 10% because position sizing still has to be appropriate. I wish I would have went bigger position sizing on this trade, but looking back 5 years, the wheel strategy has been very simple to run on American Airlines. So you can see here that whenever you're selling puts, I mean, there's a strong floor. So majority of the time, I don't even get assigned. Now, if I do get assigned, that's fine because the majority of the time it stays range bound. So I'm just selling puts, and then because it's pretty range bound, you just get out of the covered call. And by the way, even when you get out of the covered call, you just get right back into it. Let's say that in August, right, I sold $9 put and nothing happened. I didn't get assigned. Here, I sold a $10 put. I didn't get assigned. And then I just continue on every single week. And then, sometimes you just don't get assigned at all. Let's say there's a little pullback here from the 18th to the 25th. You can see here it went from 13 to, no, I didn't fall down that much. But there is periods of time where it will fall. Especially here, it fell, right? You get assigned. What do? Covered call, right? So then you get out, sell more puts, right? You might get assigned, you might not. And then you do covered call, right? Sell puts. Here you will get assigned and you would actually go down a pretty significant amount. But again, it's not really that long of a time period. It's only like 2 months. And by the way, I'm pointing you a very, very, this is the most difficult time. And I still wouldn't be concerned because again, $10 is my support level for American Airlines. So you go barely below 10 and just continue to sell puts and covered calls. So you would have collected enough premium here that even here, even if you got out of the, still be, in my experience, it was still a gain here because I've done it for so long that the premiums added up more than this drawdown. Now, also keep in mind that whenever the stock falls a lot, I do try to sell above my average cost. So even if I fell from 8, first of all, you wouldn't really get it at 18. That's the peak, right? If you're selling puts out of the money, I mean, it's not really possible to get assigned. You're not going to get assigned at the peak, right? So, realistically speaking here, you might sell a put option. And I mean, even if you wait a little bit here, let's say that you got assigned at 14 or so, right? I would still try to get 14 in the covered call. So oftentimes if I ended up coming down like this much, I would just wait or I would sell partial covered calls, right? The wheel strategy can be kind of decomposed in a way, okay? So you don't have to do the covered call in step number 2 right away. You don't have to always rush for it. I typically do rush for it. Now, I have some advanced techniques that I won't really cover in this course. It's too much for YouTube, but I'll kind of try to give you the sum of it, okay? Either if the RSI is very low, I will not sell covered calls right away because then there's an indicator that the stock might come up and it's oversold. Okay. So when I get assigned, I also kind of ask myself, hey, am I happy here getting assigned for this level? Or is the RSI low? Bollinger Band is low. Okay. I'll show you some more technicals a little bit later in this course. Or the indicators telling me that this is too low? If so, I will just hold on to the stock and not sell the covered call yet. If it's just a normal assignment, which is the majority of the time, you're just kind of barely in the money, right? Because there's not that much volatility. Again, it doesn't have to be American Airlines. You can use a different stock. Then I'll just sell covered calls right away. And then the covered calls, I will, generate income and collect premium. And from there on, I will just either let it go or I might actually roll. Now, rolling is a topic that I'll kind of point you to later on. Let's see kind of what positions I have open right now. I'm going to go to total return here on my stocks. Again, American Airlines doing very well. I ran them down. This is the first step of the wheel strategy I have here. This is doing well. Let me find a covered call that's not doing well. Okay, so Shopify would be an example because I sold puts to get in. I have Shopify stock and now I have sold covered calls. And I think I'm down in this position because it's losing money and it's losing money on the covered call, meaning it's probably in the money. So because the Shopify is in the money, 115 and Shopify's at 122, and let's say I don't want to lose the stock, right? I'm down here, but not by much. I'm only down like $580 and like 16%. 16% is not that much since options are volatile. So 16% on an option is like, not as crazy as it is on a stock. So I have 4 contracts here. And what I can do is I can like roll up. Okay. So I'm going to go roll this position. If you want to get deep into the weeds of rolling, you can see here in the description of this video, I have a whole rolling course, which you can check out. It's a rolling course, which is like many, many different examples of rolling puts, rolling covered calls, rolling leaps, etc., etc. It's very down and deep in the weeds. So if you want to spend time on that, do so after this video. I would say it's a more advanced kind of strategy and it'll be in the description for you, but I'll just show you kind of the basics right now of rolling. Rolling essentially, when you want to do a roll in the wheel strategy is essentially just if you don't want to let go of the stock. So let's say that I like, Shopify, which I do. I actually have the stock and I'm showing you real live money that I'm, using and investing myself. So look, the July 17 here, I can simply push it out. Okay. Remember the beginning of this course, I said time is money and time is very valuable. So more time is valuable. Why? Because, well, look, this is the same option. There's no difference. It's the same strike. Only difference is time, 35 days, total credit, $2,492. Why is it $2,492? Well, time, that's it. Only time, okay? So time is worth something, but also because time is worth something, it also means that you can change the strike price as well. So I can turn the 115 call option here, strike price, and I can roll it. And a roll is essentially just buying back the 115, purchasing it back, okay? Buying to close, okay? I could buy to close. You can see here it says buy to close because I originally sold it to open, right? In the wheel strategy, you sell the call option to open to collect the premium. And now I don't want to let go of this covered call. So I will buy to close. Okay. So I buy to close the 115, but then I open up a new position. This is what a roll is. Then I open up a new position at 120. So I sell to open 120. So I could change the strike price from 115 to 120 and actually still collect the credit here, collect the credit of 1368. So that right there is a roll. That there is a very attractive roll, to be honest with you, because 35 days, I get a benefit of 115 changed to 120. It's a change. It's a different price now, right? I get to increase the level at which I would exit the wheel app. So I increase my wheel. It's like an increased wheel, $5 increase, right? And that's amazing, right? So I get a $5 increase and then the total credit here is 1380. So this is an example of a roll. So yeah, I've taught this to thousands of students and my portfolio has greatly benefited from using the wheel. It's basically getting paid whether you're waiting, whether you're buying into the stock, or whether you become an owner of the stock and then you start to generate income and sell premium on the stock that you own. So it's really wherever you are in those three stages, right? Whether you're, you're in the buyer stage, which is just like you're about to get assigned, whether you're already owning the stock, or even in that pre-stage when you sell the put option, just waiting. All of those three stages are pretty attractive. Okay. The only time any of those three stages would not be attractive is if you got the wrong stock. So it's hard to go wrong with the wheel strategy unless you have the wrong stock. If you have the wrong stock and you're chasing premium, you're chasing whatever high implied volatility is, and you don't actually like the stock, then yeah, in any of those three stages, you have bad news. Whether you're in the waiting stage when you sell a put option, it goes into the money, you're like, oh man, I do not want to get assigned, right? You don't want to get assigned? Not so good. Not a good situation to really be in. And that's just the beginning one. Later on, obviously, you don't want to be the owner of the stock. So, kind of rule number one is don't chase stocks. But rule number two is don't own stocks that you don't want to be in. That's simple as that. Okay. So, you're not trying to collect the most amount of premium at the expense of being in a whole bunch of trouble. You're trying to collect rent without having too much volatility. That is your goal. Okay. That's the goal. That's my goal. That's what I've been teaching my community for a very long time. It's how do I collect rent without experiencing too much volatility? That's it, right? That's also what you want if you own a property. If you own a property, you want to rent the property out and you want that tenant to have a nice job, a wife, kids, and just pay you every single month and not to lose his job. That's the goal, right? Well, it's the same thing for me, at least with option trading. Yes, there's other strategies that I'm going to teach you after this, but when it comes to the wheel, you're pretty much like a landlord. You're just trying to collect rent and you don't want to be in too much volatility. Okay. So you are trying to get paid to get assigned, get paid to get assigned. That's the whole goal right there. And then ideally, another kind of more advanced like management technique for me, especially when I work with like one-on-one students who have had success with the strategy. Once you become successful with it, right? Once you understand the whole framework, the foundation, once you're running it, that's not the hard part. The hard part is emotionally managing it because when you have the stock, when you get assigned, right, and you sell covered calls, and your thesis was correct on the stock, you've done your research, you're excited about where the business is heading, and then it goes up into the money and it goes up a lot, you will have FOMO. You will feel like you are missing out. Why? Well, I mean, I can show you an example of kind of where I feel like I'm missing out. So let me go into AMD. Like AMD, man, I feel like the next strategy we're going to cover, by the way, is leaps. And here's like a leap option I'm going to go over. I'm going to give you a little teaser into what I'm going to cover. But I'm going to show you kind of like when you have a stock like AMD that goes up so much in the wheel strategy, why you're going to be kind of feeling the FOMO. First of all, little teaser into the next strategy, the leap strategy. I made this amount, like I made 558%. That's how much I'm up on this leap option. But anyways, before we talk about leaps, let's finish off with the wheel. If the wheel goes into the money on the covered calls, for example, like AMD, I have a 200 call here, and obviously, like the stock just exploded to over 500. You're gonna feel FOMO. This is an extreme case of FOMO. This is not the typical case, and obviously, you're not gonna have just one position. You're gonna have many, and you're gonna have leaps ideally in your portfolio as well. But when a option goes into the money and you feel FOMO, remind yourself, this was the plan. This was the plan when I entered the trade. Henry told me the wheel strategy is for generating premium in my portfolio. I am running the wheel strategy to collect premium, not to massively grow. If you want to massively grow, you would use less of the wheel. If you want more of the premium, which I think so many people want nowadays because not everyone has jobs nowadays, right? AI is taking over people's jobs. So if you have to rely on your portfolio, you need your portfolio to produce. I would say you don't have the luxury of only going for growth. You need to have that passive income approach, the conservative approach, and then some of the growth as well. Okay. So just keep in mind if you feel FOMO, remind yourself that sometimes that's going to happen. That's part of the game. Like, really, that's part of the game, right? So, position sizing, keep in mind up to 10%. If you have the wheel strategy on a riskier stock, then you probably wouldn't want to go 10%. You can go like 3%. You can go 5%, for example. 10% is really more so for those Mag 7 stocks that I personally like love. Man, Nvidia, Meta,
Palantir specifically right now, I really like because it's at $109 per share as I'm making this video. And at $109 per share, I think Palantir is such a steal. At $109 value for Palantir, insane. Because Palantir, in my opinion, is worth like 140, 150 in 2026. 2027 might be even more than that. It might be like 170, 180. Well, anyways, 109, I would be so attracted. I am so attracted to the stock at 109. So I would not do the wheel strategy on Palantir because I'm going to be feeling FOMO. I already know that. So I don't want to put myself in a position of feeling FOMO. It's like, yeah, no, I don't want to be in that position. It doesn't make sense, right? So ideally, you use the wheel strategy for bullish positions, but moderately bullish positions. You don't want to be mega bullish on the wheel strategy. All right. Now, let's go into our next chapter, which is going to be on leaps. All right, leap options, guys. You're going to need a bigger boat for this one. You're going to need to have a stronger boat, bigger boat. Your pockets might be a little bit wet from the seawater because you're going to be enjoying life when you learn about leap options. A leap option is a call option with a long-term expiration date. And I love leap options so much. Leap options help me generate more money than I have generated on any other single strategy in option trading personally. Okay. So there are risks. You got to still be careful with the strategy because a leap strategy is essentially a call option strategy with a long-term expiration date. Therefore, if you're right, man, you are right. You are, yeah, I don't know, you're smelling flowers. You're like with the flowers all day, right? The flowers that I got my girlfriend, right? You are smelling flowers. You're on that boat. You're having you're just eating steak and lobster, right? But if the leap strategy that you're using, you pick the wrong stocks, those stocks go down or the market's crashing, they are gonna potentially lose all the money, right? There are ways to manage the strategy though, so it's gonna be very important. I'm gonna show you step by step with examples how I'm managing leaps because I almost never let my leaps expire. That doesn't make sense to me. The leap strategy that I'm using is essentially me making a bet on a stock. I wait 1, 2, or 3 quarters at most, and then I'm usually cutting out the position and getting out of the leap trade, right? So I'll explain you kind of what this looks like. So, well, first of all, let's start off with AMD, which we kind of teased in the last section of this course. AMD here, $200 call option. This is something that I bought in January. I bought this in my challenge. So I started a challenge. I do that sometimes if you want to be part of them. I do it about every quarter. You can sign up for my free email newsletter. I'll either send you some value, some stock picks, I'll also show you some strategies, but I might also send you a upcoming date for a challenge, right? So whenever I do that, you could be invited there. So that's the link in the description. It's just a free email newsletter, and then I'll send you the next dates. But in my challenge, I essentially created a 1 year challenge. Okay. So that was in January. I started it for the year of 2026. And one of my most bullish plays was on AMD. I thought that AMD was a GOAT play. I thought it was goated because everyone was like paying attention to NVIDIA. Everyone wanted to be in the, S&P 1. S&P 1 is like the biggest company in the world, NVIDIA, which I don't blame anyone, right? NVIDIA is like the AI infrastructure play. However, AMD and NVIDIA are so correlated. They are so correlated, yet AMD was struggling. It was going down while NVIDIA was going up. Didn't make any sense to me. I also thought management for AMD just is very good. I think they're going to execute. So I ended up buying a call option here and I spent, let me go into history. Yeah, January 5th. Ended up buying it for $200, 918 expiration. So I went for kind of shorter than a leap because a leap is a 1 year call option. Okay. Here, this is a 9-month call option. And the whole point isn't to get into definitions. Okay. The whole point is a call option is a bet on a stock to go up. Just, simply what we covered before. And a leap option is the same thing, but it has more time. So you're not at the mercy of, having short time. You have a lot of time. Therefore, a leap option is not decaying super fast. It's not decaying so quickly because theta is low. Okay. Theta is very low when you buy a call option. I'm going to show you an example. First of all, I want to go over a real scenario here because AMD here, a position that I have so far made about $29,900. By the way, I also want to show you some of the other trades that my students have been taking and the feedback that they've given.
So a LEAP is simply a long-term option contract, usually with an expiration from 9 months all the way to even 2 years out. Instead of buying 100 shares of a stock, you're buying the right to control those shares over a longer period of time. And this is where it gets really interesting, because if you structure it correctly, a LEAP can behave very, very similar to just owning stock, but with a significant less capital upfront investment. So for example, instead of putting up $50,000 into shares, you might control the same $50,000 with $10,000 to $15,000 worth of capital, or even $25,000. That's still good using a LEAP option. That way, you don't have to have as big of a portfolio to scale if you're starting out as a beginner, or even if you're an intermediate investor. That's why institutions use LEAP options, not to gamble, but to create efficient exposure while managing capital. So full disclaimer, a LEAP uses less capital, but it's technically more risky if the stock ends up going down. It's kind of like a mortgage on a house. You put up a down payment and you own a much more expensive asset. If the asset falls, you lose money very quickly. If it rises, your small capital rises a lot because you're controlling this big, massive asset. That's how you make bicep over tricep money. That's how you really grow a portfolio. This is simple, but not all LEAPs behave the same way. So how does a LEAP act like a stock? This is really critical. Some LEAPs will move almost exactly like the stock will, and others barely move at all, even if you're right on direction. That difference comes down to one concept. It's the most important concept in this entire strategy: delta. So before we talk about strikes, expirations, or anything else, you need to understand how your position actually reacts when the stock moves. Delta is exactly what determines that. Think of it like this. If a LEAP has a 0.8 delta or 80 delta, it will move 80 cents for every $1 move in the stock. So instead of owning 100 shares, you're essentially getting the behavior of 80 shares. That's why some LEAPs feel so powerful. They actually move like the stock would move because they have 80% of that movement, but the cost could be half, 1/4, depending on what you pay for the premium. And other LEAP options may feel really slow because their delta is just too low. And we'll talk about the mistakes of really low delta and out of the money options. Now, this is where most beginners go wrong. They will buy cheaper out of the money LEAPs thinking that they're getting more leverage. But in reality, those contracts have very low delta. So even if the stock does move in their favor, the option has little to no change. Out of the money options usually expire worthless. So buying them is dangerous. Because options expire out of money, you're able to lose all the capital that you pay in terms of premium to buy that option. On the other hand, deeper in the money LEAPs have higher delta, which means they behave much closer to how the stock would itself, giving you more consistent exposure. In fact, once you finish this course, you may not really want to buy stocks anymore at all. Let's go over a real example using SoFi stock and Netflix stock, and I'm going to display to you what deep in the money LEAP options look like versus out of the money options. All right, so the position that I want to go over right now and show you what an in the money option looks like, we're actually going to use AMD, and then I'll cover SoFi and Netflix as well. But AMD is a current position that I have a LEAP option on. It's a $200 call option on AMD, and I ended up buying this in January. So I was having a program that I was running, and I told my students that this is a position that we're gonna get into. This was on January 5th. Now the option that you see on the screen right now expires on September 18th. So when I opened this option, it was roughly a 9-month to expiry option. Now technically a LEAP option is a 1-year option. However, I consider a 9-month option a LEAP option as well, because it basically functions very similar to what a LEAP option would. It gives you that long-term exposure, it gives you that capital efficiency, and there's plenty of time before theta really kicks in. Theta is what hurts the option. It's as time goes on, the option decays in value, and that's what is known as theta. So this option right here, the AMD 200 call option that I'm up $11,000 on, is in the money. It's actually deep in the money. The reason why it's deep in the money is because the current value of AMD as I'm making this video is $356 per share. If you're watching this video in the future, that's perfectly fine. I just want to give you the education tools that you can use for your own portfolio, even way into the future, so you can just improve your investing skills and just learn from me. Now, AMD, $356 per share. This strike price on AMD is $200, so I'm in the money by over $150. Now, if we scroll down here, I want to show you what the delta is. The delta here is 94, extremely high delta. Now, this delta is already so high that basically whenever AMD goes up $1, my LEAP option goes up by 94 cents. So if AMD were to go from 357 to say 367, up $10, then my option would go up $9.50 basically. So very, very similar movement. However, keep in mind, if you own 100 shares of AMD, that's $356 per share. That means that you have to have $35,600 to own 100 shares. So if it goes up $10, you can see on the screen right now, $10 divided by $356, that's the return, right? So if AMD goes up about $10 exactly, then that performance is roughly 3%, right? However, if AMD LEAP option that you purchase goes up by $9.50, now let's do the math for the LEAP option. $9.50 increase now is going to be divided by the cost of the LEAP. Now the cost of the LEAP is only $164, which means that the capital required is $16,000. So instead of having to pay $35,600, you only have to purchase the LEAP option in this example for $16,000. So when AMD stock goes up by $10, this LEAP option gains $9.50. Dividing $9.50 by $16,400, you get this return. So this return that we get from the LEAP option is greater than as a percentage return versus the stock itself. And again, the reason is because there's leverage. A LEAP option does not need to use the same amount of capital. Now, this is a really deep in the money LEAP option. Let's go over another example. I'm going to show you an example on SoFi, and we're going to look at a SoFi LEAP option. So SoFi is down a lot over the last 3 months. It's down 27%. Year to date is down 38%. So let's just say that we want to bet on SoFi to recover. So you can go to trade options. And now what we're going to look for is an in the money, deep in the money to be specific option that is a LEAP. So we're going to go out to a future expiry. And again, 9 months is okay. 1 year is really, what a LEAP option is. So I'm going to go for June 17, 2027 as an expiry date. Now, if I go to buy call option, what I want to look for is a delta that's around 0.7. That is a sweet spot delta that you want to use whenever you're buying a LEAP option. The reason is because whenever you look at a LEAP option that has an extremely high delta, that LEAP option is going to be really expensive. So for example, if I go down to the 10 call option, this delta is 0.86, but you're kind of getting diminishing returns here because you are now paying $8 to buy this LEAP option. However, the 15 call option is only going to cost you $5. So it's a lot cheaper compared to just buying super deep in the money call options. So here it's kind of like the sweet spot because it's still in the money, it's 70 delta, and you have a lot of good exposure without having to really overpay. So here, if I go into this 15 call option and I click it, you will see that there is a bid of $5.20 and an ask of $5.30. The delta is 70, and if I were to buy this option, essentially what would happen is that the 15 call option is going to cost $5. That means I get to control 100 shares for just $5. This $5 helps me control basically $1,600 worth of SoFi because 100 shares would be $1,600. So if I click this option right here, my break-even price is $20.25. Now, keep in mind, this means that if I were to hold this option until expiry, that I would need SoFi to be $20.25 just to break even. However, as we will cover later on in this course, it's very important to actually not hold a LEAP option up until expiry. The reason is because in the last month, 2 or 3, theta really starts to kick in and eat away at your options value. So in a majority of situations, I do not hold my LEAPs up until expiry. But we'll talk about that later. The whole point here is a deep in the money option like this one that we're looking on the screen right now, a 15 call option that's worth $5. This is basically an optimal setup for a LEAP option if you think the stock can recover. So let's say that SoFi can go to $25 per share by, June or a little bit before then, let's say March 2027. So as it approaches $25 or $30 per share, this LEAP option is going to gain value. If SoFi stands the same, then at first nothing's really going to happen because a LEAP option has very low time decay, meaning that doesn't really lose that much value at first. So there is a lot of benefit to a LEAP option because you have time to hold this LEAP option and see if your thesis on the underlying stock is going to play out or not. If it doesn't play out in the first, few months, then you can end up just cutting the position for very minimal losses. Okay, we'll talk a lot more about this later on after I cover more details on the Leap strategy, but that's SoFi. Let's go into Netflix. Netflix is also, a pretty interesting stock, but this course is not about specific stocks. It's more around how to use this strategy. I used to work at Goldman Sachs. I've scaled my portfolio and I've learned a lot of things along the way. I made a lot of mistakes, and Leap options are definitely one of those more powerful strategies, which if you do them incorrectly, you can lose a ton of money. But if you do them correctly, it is a, interesting way to scale a portfolio. And in my experience, it has been very fruitful for me, as well as my community and my students. Now, Netflix is currently trading for $93 per share. You can see how Netflix was like $108 not that long ago. And in the 1 year chart, Netflix has had a good amount of volatility. So let's just say Netflix or whatever stock you think is going to come back to, a more recent 52-week high or peak level. So, for Netflix, it's 133. So then you can also do a deep in the money option, right? That's the whole point of this course. However, let me show you what can go wrong if you do an out of the money option, okay? So again, keep in mind, Netflix going to 133. Keep that number in mind, okay? 133, okay? I'm going to show you how buying an out of the money option can still be unsuccessful even if the stock goes up back to like some big level, right? So 133 would be really, really nice. That's a really huge increase in Netflix, right? From 93 to like 133. That's basically like 40%. If I'm correct, right? So whatever, I'm going to put that math on the screen right now. That's a huge return that is very unlikely to happen especially in a short amount of time, right? Stocks don't usually rise that much in a short amount of time. But let's just say that our belief is that that can happen. Okay, so I'm going to show you how even if something really good happens, you can still lose money on a Leap option if you don't set it up correctly. So let's go to trade options, and then let's just do the same June 17, 2027. Now, again, so let's say that we're going to buy an out of the money option and we're going to go to 130. Okay, so we're going to bet on 130. The delta here is 28, which is, by the way, not too terrible. 28 delta means there's a 28% chance of this option expiring in the money. So if it, goes to 130, that's basically almost a 30% chance of happening. 28% chance to be exact. However, look, our break even is 135. So even if Netflix goes to $133 per share, which again is, a massive return that's not that likely to happen in majority of cases, right? Let's not speak about this specific case. Broadly speaking, a stock won't make that huge of a rise on a consistent basis, right? Otherwise, investing would be too easy. Hey, it's not too easy, right? It takes a lot of dedication, skill, and stock market returns are typically 10%. So if you can get 20, 30% per year, you are beating the average investor by a whole lot. You're definitely beating the S&P 500 by a whole lot. And most investors just don't do that. And the biggest mistake is just buying out of the money call options. So thinking that this is cheaper. And yeah, it's a lot cheaper to buy a 130 call. It's $5.60, right? Versus if you were to buy a deep in the money option, so that would be like the 85 strike price here, right? Delta 70. However, the cost is like 4 times more. It's $22.50. That's a lot more expensive. But this is like night and day in terms of like the performance that the Leap option kind of gives an investor as the stock rises. As the stock goes up $1, this call option right here benefits by 70 cents versus the other one that we're like looking at right now, the 130, only benefits by 28 cents. Now, as a percentage return, that's pretty big, but the decay is going to be just so massive here. So let's look at the decay, theta decay. So the Greeks on the bottom, these are important variables, and they basically explain how the behavior of an option really works. So delta is how much the option changes. But there's another definition of delta, which I just mentioned, is basically the chances that the option will expire in the money, meaning like how likely is it to get to that level at all, like just to be at that level. So that's delta, and it's really important. We'll mention more about this as I go through more examples, but theta here is 0.0168, which basically, since each option is 100 shares, this means that this option is losing $1.68 per day. Doesn't seem like a lot, right? But it's kind of a lot considering that this option has such a long time to expire and it's already losing that much per day. And the value of the Leap is only $5. So as a percentage return, you're losing a lot on this 130. However, if I go down to 85, I want to show you kind of the difference here. So the difference here is that you are losing $2.13. However, the amount that you have to put up for this Leap is so different. It's 4 times more expensive. So you're losing just a little bit more dollars, but as a percentage return, as a percentage of loss, it's very, very low. So although it's a little bit bigger in terms of overall efficiency, it is way, way better in terms of overall efficiency. Also, keep in mind, whenever you buy a deep in the money option, it already has some intrinsic value. We'll talk about intrinsic value. I'm giving you guys a lot within this one example, but I'll give you more information on why an in the money option also has other major advantages. So let's talk about intrinsic value. Intrinsic value is the real value an option has right now. So as I just showed you in that example, an 85 call option or leap option on Netflix already has value today. The reason why it has value right now is because Netflix is sitting at 93 and that call option is at 85. So the value intrinsically is already $8. If nothing happens, it's $8. Whereas the other option that's at 130, which is out of the money, has absolutely no intrinsic value at all. It's not worth anything. The only reason it's even worth the $5.30 that we saw is because it has something called extrinsic value, right? Intrinsic value is how much this option is in the money right this second. Extrinsic value, on the other hand, is everything else. Time value, expectations in the future, and volatility. This is the part of the option that decays over time. It's not intrinsic value that decays because it's intrinsically worth something. So that's not really decaying. What's decaying is all that time, all the possibilities, all the potential. That is decaying as the option approaches expiration. If it's not moving towards the strike price, or if it's not moving higher, all that time value, it's going to decay and be less valuable. For example, if we look at a really awesome stock that I personally like, Nvidia, and let's say it's at $200 per share, which that's roughly the price. If you were to guess kind of in the next 6 months, where could Nvidia be? 220, 240, 250, those would be, guesses, right? And that is basically one factor of time, 6 months. However, what if I said in 10 years from now, where could Nvidia be, right? There's a whole lot more possibility. What can happen in 10 years? Autonomous robots and all kinds of other inventions and technologies and AI continuing to just grow to the point where none of us have to work potentially and just whatever. There's lots of crazy things that can happen in 10 years, right? So the value of Nvidia might be 500, 1,000. It's possible. It's possible because there's so much more time. That time is a really huge variable. That time variable really makes up all that extrinsic value that, options have. So this is the key insight. The more intrinsic value your leap has, the more it behaves like stock. The more extrinsic value it has, the more it behaves like a trade that needs to be right quickly. If it's not right quickly within that time frame, you have a huge risk. Maybe you will lose all the money that you put up for that option position. So one has value now and the other only has opportunity to become valuable in the future if the stock rises. Now, if you're right about a rise in a quick, short amount of time, then yes, you can make a bunch of money on out of the money options. However, that's not my style. That's not what I teach, and that's not how I personally became successful. I became successful by strategically looking at in the money options and trying to basically use it as a strategy to replace stock. That's why in this strategy, we typically favor a deep in the money leap as it has more capital requirement, but it behaves much more similar to a stock. And as I show you later, it's also much easier to manage that type of position versus an out of the money option. Now, because you're minimizing decay and maximizing the value that you already have, that's also going to help you a lot in terms of drawdown risk, because what happens is if the stock goes down, leap options lose value. If the leap options out of the money, there's no value that it even had intrinsically, so you just lose everything. However, with an in the money option, if it goes down to a certain level, you can just place a stop loss order and you can end up losing but recouping about half of the loss, for example. So later on this course, I'll show you kind of how to manage that type of situation because it is case by case. There's a lot of risk involved with leaps, but overall in a bullish market, which is most of the time we are in a bullish market, especially over longer periods of time, the leap strategy can outperform significantly. Now let's move over into the third chapter of this course, which is going to be contract selection. This is where a lot of investors fail. The best setup, in my opinion, is an expiration selection of 9 months to 18 months. 2 years is a kind of a long time period. 9 months is a level where you have enough time and it's not too short where time decay is really kind of eating away at your option. Technically, again, a leap is a 1-year option, but I consider 9 months close enough because theta and time decay does not eat into the option at that point. So that's the time frame for expiration. Now, let's discuss strike selection. I personally love 70 Delta, which is a deep in the money leap option. Deep in the money options are safer because most of what you're buying is real value, not hope. Deep in the money equals mostly intrinsic value. Now, it doesn't have to be massive intrinsic value as long as it has some value in a high delta, because that's the formula for stock replacement. A lot of investors, they're buying shares, doing covered calls, and they're doing more capital intensive expensive strategies. And that's fine if you have a big portfolio, but if you are someone that has a smaller portfolio or a medium portfolio and you're looking for growth, well, something like the wheel strategy or covered calls and selling puts, they're good strategies, but they're definitely not the type of strategies you really get that massive growth in place. So this is how you get the upside in close movement to a strategy like owning just regular stock, but with the leap option where you have to put up a lot less capital. Now, the only thing that can really like destroy your returns is theta. Theta only destroys extrinsic value, as we discussed, not intrinsic value. So as time goes on, your option controls 100 shares, and it's really not decaying in value very much, especially in the first few months. But as we approach the later 3 months, that's where the option can really decay in value, especially if it's not really that much in the money, right? The example that I showed you on Netflix where I do an 85 call option and Netflix is at 93, that's $8 in value. That's good, that's in the money, but it's not like AMD, which I have a 200 call option and AMD is at 350, 360. That's a very different position because one has intrinsic value of $8, another one has $150 worth of intrinsic value. So of course, the higher intrinsic value that you have, basically the safer you are to stay within that zone. Now, deep in the money leaps don't need the stock to move fast like a really risky short-term call option would. They have a long expiration, so you really get to have the stock-like return. Let's go over another example of a leap option that I currently have in my portfolio. This is going to be on Meta. Meta recently had earnings, the stock went down, and my current leap option is actually a $600 call option that expires on January in 2027. Now, this option is still in the money, but it did lose a lot of value. You can see here how I am down personally $4,000 on this position. I'm down 31%. Yet before earnings, this company was doing really well, but Meta dropped after earnings, and that's fine. Earnings can sometimes drop companies. So this leap option looks a lot less attractive after Meta ended up falling. In fact, you can see here the value of my leap option, how much it actually dropped. I should have actually cut this position and I should have taken profit. This is probably a mistake on my end because Meta, the $600 call option was worth $133, even $140, $140. So this position, which you can see here, I ended up buying, let's see, Meta break-even price, current Meta price, market value, current price, average cost. So I have it at an average cost of actually 131. So I paid pretty handsomely for it. However, you can see that the value was at 140. And this was, not that high of a return. Let's go to the 1 month here. The value was basically as high as 148. So I haven't really had a chance to even make a decent profit on this position. I wouldn't really take profit off of a position that I bought for 130 and now it's at 148. That's just not enough. My typical exit point, what I like to set is about 50%. So if I buy a leap option for 130 and now it's worth, 50% more, which would be about $65, which would be $195 total. That's a good exit point. That is a point that I would want to take an exit. So this option was very deep in the money. Now the delta is 0.62, which is pretty good still. 70 is really the sweet spot. So 62 is kind of on the lower end. However, the lower end is still not an issue. I'm still in the money on this leap option. And because this leap option expires in January 2027, I still have a lot of time. Theta is really low on this option. And I want to click simulate my return because now I can show you kind of different scenarios that can happen to this leap option and when I would take profit, when I would look at delta. So first of all, delta is at 62 right now. Again, that means if Meta stock goes up by $1, this option goes up by 62 cents. So here's kind of some scenario analysis. What would I do? Well, right now, Meta is at $612, pretty low in terms of performance. However, let's say that in next earnings quarter, which is 3 months, right? From now until then, not a whole lot happens, but it inches closer to 650. So you can see here, as I change the price, then my simulated return here would continue to increase in value, right? I'm losing 4K and now I would only be losing, a lot less. So let's go to 650. Let's actually enter the price to make it a little faster. No, let's actually swipe here. I don't know how to enter the price. So let's go to 650. Okay, here we go, about 650, right? So I'd still be down on this position just because, I bought it for an expensive price. So this is an example of me managing this position to my best ability. Meta is down, but I'm still bullish. So that's why I'm not cutting this position. Theoretically, a lot of people would, think about getting out. However, if the underlying stock is still good, then you can continue to hold your leap option in place. There's no reason to change a leap option just because the stock is not going in your direction within a short amount of time. Again, a leap option has time. That is one of the benefits of a leap option. So in terms of managing this type of strategy, you don't have to be too strict in day-to-day stuff. You don't have to do that. This is much more of a kind of wait and see strategy. As long as the stock ends up moving in your direction, your thesis ends up playing out at some point before expiry, then you can have a profit. So for example, let me show you. All right, so let's say now that Meta ends up shooting to $700 per share. Okay, you can see this graph is going to continue to change. You see how it goes up. So today, if it went up to $700 per share suddenly this fast, then I would be up, right? But obviously that's really difficult to do. However, I want you to pay attention to this chart because if it went up to 700, even by, July, I would still be up on this position. So on July 9th, if Meta went up to $700, I'd be up on the position. However, let's say that earnings came in really, really good and Meta jumps to like $800 per share, right? So let's go to 800. I'm going to scroll here. I apologize, trying to be as efficient as possible here. I really respect your guys' time. Hey, let's just say 780, okay? As time goes on, this value would still decrease, right? Because all of this value right here is still some extrinsic value. Some of it is time. But now at expiry, I don't really have to worry because I'm so deep in the money. But I wouldn't hold it because you see here, if it stays at 780, it just continues to decay very, very quickly at this point. The slope is very kind of steep here. However, here it's not so steep. It's losing value, but very, very slightly. So 3 months from, today we're somewhere in May. So June, July, August. So in August, which is where I'm at, funny enough, August 12th, if it hits 780, I'm going to be out of this position. I'll take 6,900 for sure in terms of a gain, and I'll be happy with that. So, it is very situational. The exit points that you want to aim for is typically 30, 50, 75. A lot of it is also based off a technical analysis, which I'll show you later, but I'll give you a quick summary to give you as much value as quickly as possible. If the stock is going up and the RSI is not above 70, then there's a good chance that the stock's momentum can continue. If the RSI is very high, that's typically more resistance. That's one of the indicators I look for in terms of shorter term momentum. I'm not a momentum trader. I'm not a short-term trader, but it is a factor that I take into consideration. The other factor is Bollinger Band. If the stock goes towards the top of its Bollinger Band, that's also an interesting time to really consider taking profit from your LEAP option. We'll go over Bollinger Band a little bit later. Now, let's talk about another important factor within this course. In addition to strike and expiration selection, it's very important to select the right stock. Of course, this changes with time in the market. If you select the wrong stock, nothing can help you. No strategy is going to help you if the stock declines because a LEAP option is a bullish strategy. If you select a very good stock, then you can even have some leeway room on not choosing the best delta because if the stock goes up, pretty much a majority of LEAP options will be benefiting. Even out of the money LEAP options will have a shorter term benefit if the stock ends up going upwards. Let's cover some more common mistakes to make sure that you're not falling into dangerous habits and so you also understand more advanced topics within contract selection. Now, one of the biggest mistakes is just not buying enough time. Again, having that short-term tendency, having that gambler's mindset, having that really, I want to get rich quick type of mentality. That is the wrong mentality. That's not the type of person that I personally want to work with. And I don't believe that, getting rich quick is even possible. It's really difficult unless you get lucky. Now, what I'm trying to do is I'm trying to replicate success without getting lucky. So when I see a lot of traders that go 3 to 6 months and, they're trying to save money and it ends up biting them in the where, right? So that's not a LEAP option. That is just a short-term riskier trade. That's a trade that needs to be right quickly. Now, time is what gives you margin for error. When you have more time, you have a greater margin of error. Without enough time, even a good idea, it may lose money. Even some of the best stocks, they don't always have the best short-term windows of good performance within 1 or 2 or 3 months. But many good companies that report good earnings, have solid momentum, have good, investors that have a, cult-like following to that stock, they believe in that stock, management continues to guide forward, companies doing good things, then more likely that stock is going to go up, but it may need more of a time. But it may need 6 months, 9 months, or 1.5 years, right? And a LEAP option gives you that advantage. Now, the other mistake that I see is really around events and timing. Buying LEAPs during hype times or, really tough political news or right before earnings can really have inflated prices. Even if the stock goes up, volatility can drop and cancel out all of your gains. So you can be right on direction, but you can still lose money. That's a very frustrating mistake to make. The other mistake is position sizing, just having way too much in one single position. That's what I call bad risk management. LEAPs use less capital up front, which can lead to oversized positions. Despite being long-term, they still involve leverage and risk. If a stock does not move higher, the LEAP can lose money. Large positions increase downside impact if the stock declines. Now, holding too long is the other mistake that I see happening literally all the time. A lot of investors just become so married to their position that they forget that there could be a fundamental change in the company company, or just simply time to take profit, and they end up getting way too greedy. And we will talk about holding period and managing strategy again when I go over my live example. Here's a quick summary if you made it this far. I want you to just have a full deep understanding before we move into the next chapter. Time decay accelerates as expiration approaches. In the final months, the option becomes more sensitive to time. Managing or exiting before that phase helps preserve value. Last, buying cheap out of the money LEAP options is, attractive for a new investor. They think there's a ton of money to be made, but a lot of people go for the cheap contracts thinking they're going to be, getting a lot of leverage, but what ends up happening is most options just expire worthless. So these investors just end up losing money. So these contracts usually just have low delta and are made up almost entirely of extrinsic value, of possibilities, what may happen, but no real intrinsic value. That means if the stock moves in the right direction, the option really barely responds, or even if it goes up as expiration approaches, it ends up still being out of the money. Cheap contracts often come with low probability and super high risk that isn't worth it in my experience. Even if the stock moves up, you end up losing money. Exactly like the example that I showed you on Netflix if you buy a $130 call option. And that's basically where the worst case scenario can come in. You end up losing everything that you paid for the option. Now, my goal is to teach and educate you so you have proper position sizing, you don't risk too much in any one single position, and that LEAPs end up being a powerful strategy for you to use on ideas that you already like within the stock market. So my final rule set is go for delta that's around 70 or up to 80, time frame between 9 to 12 months as really that sweet spot time frame, strong underlying stocks that you really like and that you want to own. And then the goal is to exit the trade before it gets into the final 60 to 90 days where theta starts kicking in a lot more. All right, let's get into the fourth chapter, which is theta and time decay. In this chapter, I'm going to show you how to manage a LEAP position that you are already in. LEAPs decay slowly in the beginning, but that decay accelerates towards the end. When you buy a long dated option, you're buying a large amount of time, and that time doesn't lose value evenly. It does not happen in a linear process. Early in the life of a LEAP, the time value is spread out over many months. In that early phase, it could decay maybe, let's say in the first 30% of time, it may only decay 10% of the value. In the last 30% of time, it may decay 50 or 60% of the value. So there's a skewed amount of value that a LEAP option loses with more of it on the back end. So each day that passes, that only removes a small portion of the value at first. Think of it like this. Losing one day out of 400 days is almost nothing, but losing one day out of 30 days matters a lot more. That's why LEAPs feel stable early on. There's simply too much time left for decay to have a meaningful impact day to day. And that's where a LEAP option is really the most powerful. And as it approaches towards expiration, that's when you should be taking profit or just cutting the position for a loss if it's down. My management plan is to evaluate the option at the halfway mark and make a decision at the 6-month mark to either, cut the position for a gain, give up on the position, or to actually even double down on the position. The 6-month mark is a really awesome time to basically make a decision because it's the halfway mark. And this is where a lot of the time decay actually starts to shift. At that point, you're removing a large portion of uncertainty if you end up getting out of the position. However, if you continue to stay in the position and momentum continues to go in your favor, that's a great time to continue to profit as well. You really want to take guessing out of the equation. When you're looking at managing the strategy, you want to take guesswork out of it. You want to understand the direction. And again, that is going to come down to momentum factors, RSI, Bollinger Band, and more technical indicators that I'm about to go into. Chapter 5, implied volatility. This is really the hidden edge. Implied volatility determines how expensive your option is, independent of the stock price. When volatility is high, options are priced higher. When volatility is low, options are cheaper. There are two factors. IV expansion, this is basically when there's an increase in the option value because IV is going up, or IV contraction, where there's a decrease in option values. If you buy a LEAP during low volatility and it expands, you benefit from both the stock movement and the pricing of the stock going up in terms of the option value being more valuable since there's higher implied volatility, more risk. Higher risk means higher pricing. If you buy during high volatility and it contracts, it can reduce or offset your gains. This is where many traders make a mistake. They buy LEAPs when there's a lot of volatility and it's already elevated. So often during hype, strong rallies, or major events, they end up overpaying. They're buying LEAP options because they're excited. They're, have so much enthusiasm because the market's doing good and they feel richer. But that's not a good time because when volatility is high, options are expensive. Now, earnings are the clearest example. Before earnings, volatility increases due to uncertainty. After earnings, that uncertainty is removed and volatility ends up dropping. falling. This drop is known as IV crush. Even if the stock moves in the right direction, that contraction can limit gains or create losses. For leaps, this matters less than short-term options because this factor within the Greeks doesn't affect it as much. What really affects a leap option is the stock movement itself, which again goes back to the point. It is a good stock replacement strategy because the leap option isn't affected too much by outside factors. Because you're holding a large position over time, paying too much upfront though can reduce or even kill your overall return. The best situation for an option trader is what I will call double tailwind. If you own an asset like a leap option which benefits from upside growth in the stock, a double tailwind is when you have a rise in the stock market pushing the value of your leap option higher and an increase in volatility which also raises the option's premium at the same time. This powerful combo explodes the value of a leap option. This is because you have an increase in value from an appreciating market, and greater volatility also makes the option more valuable. Chapter 6, risk management. This is what really separates a beginner investor who makes a ton of mistakes from a more seasoned investor who really understands how to limit their downside risk. Most people focus on finding the right stocks, but what actually determines your outcome is how you manage each and every position that you hold.
Alrighty guys, let's go over the simple risk management guide within this Leaps strategy course. So I want to give you the most powerful techniques that have helped me manage leap options and also protect myself because risk management is incredibly important. Most traders focus on returns, but professionals really focus on risk. And you can survive being wrong, but you cannot survive blowing up your entire account, right? We can be wrong. We're not going to have a 100% win rate. That's just not possible. So the goal is not to always maximize gains. The goal is actually to maximize longevity. So if you can do leap options on a long-term basis throughout the years, then you have a very good chance of building long-term wealth. However, if you end up blowing up your account, you end up kind of quitting this game, then you're a loser. Right? So my goal here is to help you have longevity in trading options. I want you to be able to do this for the next many years and decades into your retirement, right? And the way to do that is really to protect your downside, to manage risk. And a great trader with poor risk management, even he will lose, right? I'm telling you, even the smartest people in the whole world with fancy degrees from MIT and Harvard, Stanford, etc., even if they don't manage risk properly, they will end up losing. So I really want to put you in the mindset that everything that I cover in this course is very important, but risk management is incredibly important because risk management is what allows compounding to really work, right? Warren Buffett says rule number 1, don't lose money, and rule number 2 is follow rule number 1. So I really want you to understand that risk management is what allows compounding to work, and one bad decision can erase literally years of gains. Every position should have a plan before it's entered, right? So let's go back here to the Amazon example that I did before. Okay, I have the 225 leap option here open, and if Amazon continues to go down here, then I need to make a risk management decision to potentially cut this. So if Amazon goes below 225, very simply, that is a point where I would cut this for a loss, right? Because I don't want it to go to being an in-the-money option with a delta of 0.7 to becoming an out-of-the-money option with a delta under 50. That's one of the most important risk management principles that I personally use is if it goes to an out-of-the-money option from clearly leaps being in the money, the way that I do them, and it becomes out of the money, then hey, I'm looking to kind of get out here because I want compounding to work. I don't want to lose money on a consistent basis. I want to make money on a consistent basis, and every position that I enter has a strategy when I enter it. And one of the most important strategies that I have is that the option becomes an out of the money option, then hey, I'm going to cut the option before it loses any more. Never enter a trade without knowing what your exit point is, okay? Because if the stock breaks down, which inevitably it will, oftentimes stocks do break down, crashes do occur in the market, you want to have proper position sizing. So let's talk about position sizing. Position sizing really matters, and it matters as much as stock selection. Even the best stocks can become a terrible investment if your position is just too large. Let's kind of go over an example here. Let's say you're investor A. We're going to talk about investor A here, and let's say that you have a $100,000 account and you end up putting $8,000 in one leap position. That's already 8% of your portfolio, and that's not crazy. I think up to 10% is okay, but 8% is not little. So if it falls down by 50%, then you end up losing 4% of your entire account. The much better situation that you can be is becoming investor B. So let's say you have a $100,000 account and you end up buying one leap option for $2,000. Now if it falls by 50%, you're down $1,000, you cut your position. That's still
good because you only lost 1% of your total account value. Okay, so I want you to understand to never marry a stock. Great companies can still be bad investments. Stocks do not know that you own them. Okay, they can come crashing down. Even good companies come crashing down. So I don't want you to fall in love with the wrong position. Okay, respect price action. Really respect price action. That's something that I learned at Goldman Sachs. When I was working there, I would see investors, very high net worth, wealthy investors, falling in love with stocks and not really respecting price action. And their large portfolios would lose millions of dollars. So I really want you to understand and respect changes in price, but I also want you to understand changes in fundamentals. Fundamentals is also very core to your thesis. If you want to learn fundamentals, that is a very difficult topic, and it depends on each individual position that you have, because you can't always compare something like McDonald's to Amazon. These are two very different companies. So you're going to want to understand if the PE ratio of McDonald's at 23 makes sense to something that has a much higher PE ratio but is higher growth. Maybe that's Amazon or Navitas or some other AI stock. You want to compare apples to apples, which is very difficult to do when it's different industries. This is another reason I recommend that you join me in my Discord community, because it is very difficult to analyze a single stock. If you do the wrong analysis on stock selection, even risk management will be very difficult to save you, because if the stock goes down, obviously the leap option doesn't do well either. So respect price action, respect fundamentals, respect support levels. If a stock goes below support and it breaks down, then it's also a good time to really practice safe risk management and get out of the leap option. Now, something else that's really important is delta management. Okay, delta measures the stock's exposure. Delta changes as the stock moves. Okay, so if I go back here to, let's go to Chipotle, let's get rid of this $35 call option that we're going over an example before. Let's just look at 30. Okay, let's look at the delta here of the 30. So the delta is 0.6, which is going to be a little bit lower than the typical 0.7 that I like. Now check this out. The delta is 0.6. So delta measures the stock's exposure. Delta changes as the stock moves. So if Chipotle goes up, the delta is going to increase. If the stock goes down, the delta will decrease. Winning positions often become larger risks because they grow in delta. So the higher delta you have, technically you have higher exposure. And if the stock ends up coming down, you will lose money faster because of a higher delta. So monitor delta continuously. As you get into higher deltas, it's also good to cut part of the position and take profit on the position. Because if you have 10 contracts here of Chipotle, okay, let's say you have 10 contracts, right? So 10 contracts times 0.6 delta, you essentially have like 600 shares worth of exposure. The reason I'm getting at that is because 10 contracts times 6 is 6 contracts, and 6 contracts controls 600 shares, right? But check it out. If Chipotle goes up and the price increases, now the delta becomes higher, and the delta is now 0.7 or 0.8, you effectively don't have 600 shares. Now you effectively have 700 or 800 shares. So you can take some off the table. If you have 10 contracts and you end up making money and the position is up, you can cut part of the position. So if you have 10 contracts, cut part of it. Cut 2 contracts. Now you have 8 total contracts instead of 10. And now you have taken profit and realized the gain and also reduced your overall risk. Okay, and that's what I mean by managing delta. Make sure that your delta is stable. If it's increasing, then you can cut the position and take profit from the position. Now, something that I also like to do is I don't want the delta to become 50. Okay, because at 50 it's an at the money option. Okay, and I don't want a option to become out of the money. And 50 delta is essentially when it becomes an out of the money option, and that's when I would practice risk management. Essentially, cut the position for a loss. It's okay to cut positions for a loss. Ideally, of course, we take profits, and if good things happen, we follow technical analysis and the stock ends up coming up, and markets do typically rise. So we have high quality companies, especially the type of companies that I'm picking in my Discord community. I'm very good at picking which stock is likely to rise, and I've done that consistently over the last 10 years, and that's how I've been successful. As long as that continues to work and the markets continue to be more or less stable, I know there's volatility, but long-term markets do rise, and leap options benefit from rises in the long term, because that's what a leap option is. It's a long-term call option. Then more often than not, you should be in the profit taking zone, which is essentially when you're up 30 to 50%, it's a good time to take money off the table. It's a good time to realize a profit. Now, there's also time risk. So leaps have time decay. Time is an asset until it becomes a liability. In the last 1 month, it becomes more of a liability. So avoid having it in the last final months. It is not going to do you too well unless the stock moves tremendously in the last month. But then that would be basically trying to time the trade, and that's difficult to time the market, the type of strategy that I personally use in my own strategy. So avoid having it in the last final month. And also, one more thing is earnings risk. So earnings create uncertainty. Even great companies can fall after strong reports. So make sure that a company has reported positive earnings in the last 2 to 3 quarters if you're going to hold a LEAP option through earnings. All right, let's continue on with the course in next chapter.
Chapter 7. When to enter. When to enter a LEAP option is where a lot of your edge comes from. This will be an amazing chapter because in it, I will also add a bonus 5 stocks I am choosing LEAPs on now and how to find a similar setup even if you're watching this many months into the future after this video is released. Even with a strong stock and a well-structured LEAP, bad timing can slow your returns or put you in a drawdown early. The goal is simple. Buy weakness, not strength. The only time you buy strength is when a massive value gap is present. Most beginners do the complete opposite. They wait until a stock is already moving up fast, feels strong, and looks safe. I mean, it looks safe to them. But there's a difference between looking safe and being safe. When a stock is high, many people mistaken it for the time to buy. They get all excited, but that's usually where they end up overpaying. Exactly the point when you think it's time to buy. Have you ever been in a situation where you felt that way until you bought and the stock just went down right away or the next day? Well, instead, you want to focus on pullbacks, value gaps, and undervalued stocks. Look for support levels, a place where the stock just has tremendous support from investors, or look for a recent dip, or temporary fear or selling pressure. Another thing that I look for is margin expansion, which I will discuss soon. And lastly, look for a business that is transitioning into trends. These are moments where the stock is cheaper, sentiment is weaker, and your entry improves. To summarize everything so you can be successful, your exact system should start with really good stock selection, stocks that you want to own, that you choose that have really strong businesses and momentum. Then you want to look for delta. Simply choose a delta that's around 70, and after that, go for an expiration date that's roughly 1 year. Choose an entry price when the stock is near a pullback or a low, or it has sold off, or it's at support level. And when to exit, you essentially want to have a profit of 30 to 50% and consider exiting at that point. If it comes down 50% of your premium, it's also a time where you can consider, has your thesis changed, has the momentum just not been good enough, and consider exiting the position. The description only in this video contains the link to my LEAPS group direct. I placed it in this video to build a relationship and help only those that made it this far, specifically in this video. Every chapter covered in this course will have additional information as well as a monthly LEAP trade for you to follow. Remember, the group is not found anywhere else but this video as of the time of this making. If you found value in this, please don't forget to like and subscribe. I'll leave another helpful video on the screen right now. Thanks so much for watching.